I also extend a very deep thanks to the speakers in the afternoon panels for accepting our invitation. And last but not least, let me also thank Frank Elderson, member of the executive board at the European Central Bank, for sending a video message to our conference. 2022 will enter history books as the year of overlapping crises. It will surely be remembered of the year when Russia invaded Ukraine, marking the largest military attack in Europe since World War II. It will probably be also memorable for being the third year of COVID-19, the biggest pandemic since World War I, which still lingers and wreaks havoc across the globe. These shocks prompted further crises in 2022. After years of improving food security, we are witnessing the worst famine in the 21st century in Africa. Rise in food prices is only eclipsed by sky-high energy prices, which together bring about a global cost of living crisis. There is even talk about a globalization crisis. The year 2022 could very well be the one when the golden age of globalization ends and the new cycle in economic history starts, the regionalization of trade. Dear friends, as these woes dominated the international agenda, there is one major issue which appears to be taking the backseat: the ongoing climate and biodiversity crisis. Since the last United Nations Climate Conference ended in Glasgow in December, the fight against global warming, as well as the battle to defend the richest of the nature, have been slipping back on the international agenda. There are some big emitter nations which have backtracked on climate goals. Some others are just reluctant to raise ambitions despite clear guidance of the Paris Agreement to do so. As for the EU, it had already deepened its 2030 climate target before Glasgow and kept committed to that goal ever since, despite its energy challenges. It is not only nations that put the climate and biodiversity issues on the back burner. There are companies that are considering walking back on their climate commitments too. In the financial sector, there are some banks, mostly in the US, that contemplate leaving G-FANZ, a key financial alliance. Their move comes less than a year after they joined this club, pledging to phase out fossil fuels. Should they go ahead with their exit, it would send a very, very, very bad signal. Speaking of signals, nature, meanwhile, keeps sending us red signals. This year, particularly strong ones. This summer, Europe faced its most severe droughts in 500 years. 500 years. We have touched upon the possible end of the golden age of globalization. Almost to this day, 500 years ago, explorer Ferdinand Magellan ships circumvented the world for the first time. His ships, with spices from the other side of the globe, led the foundation of interglobal trade, in fact marking the birth of globalization. Not since Magellan's time have Europeans experienced such a dry period than this year. Europe was not an exception. China was hit also by an extraordinary drought. The Yangtze, Asia's longest river, dried out to such an extent that Buddhist statues built 600 years ago appeared for the first time. Water is not disappearing, it must fall down as rain somewhere. But as the climate crisis is making the water cycle spinning faster, it means it will come down somewhere else with ever larger intensity. This year, Pakistan suffered its worst flood in its history, as almost a third of the country got underwater. More than 1,500 people died, and 33 million people were affected. In California, the Death Valley, the hottest place in the world, on Earth, saw almost unprecedented rain, which damaged infrastructure. Meteorologists rated it as a once in a 1,000 year, with a 0.1% likelihood during a given year. It is not only our climate, but our ecosystems that remained under stress in 2022. Deforestation in the Amazon, the richest natural reservoir on the planet, hit a 6-year high despite repeated declaration by Brazil about protecting its rainforest. Ladies and gentlemen, no doubt that solving the cost of living crisis, which squeezes households across the world, is a top priority to policymakers, including us. We at the Hungarian Central Bank are working hard to fulfill our primary statutory mandate to bring inflation under control. But tackling one crisis should not come at the expense of solving another one, especially not the one with the most profound and most long-term impacts on the economy. We must not use any of these crises as an excuse to give up on our sustainability goals. It is actually the other way around. We need to double down and use these shocks as further reasons why we should speed up our efforts. The synergies between solving the energy crisis and the climate crisis are particularly strong. Climate action and energy security go hand in hand. Helping our energy sector rid itself of fossil fuels and move towards CO2-free sources make our societies more energy secure. The current cost of living crisis makes the case for energy efficiency improvements of buildings especially strong. Synergies do not stop at climate and energy. Conserving natural habitats is essential to reduce the likelihood of another virus sweeping the world. It requires fundamental changes in human food production, which in turn helps tackle food insecurity and make agri-food systems more resilient. To exploit these synergies, we need to keep up the momentum that sustainable finance has gained over the past years. This is not the time to take our foot off the gas pedal. Getting the financial system to work well is critical to the success of the green transformation of our economies. To understand why, think of the financial system as the brain of the economy. It acts as a coordinating mechanism that allocates capital, the lifeblood of economic activity, to its most productive uses by businesses and households. If capital goes to the wrong use or does not flow at all, we will fail to prevent runaway climate change and slow down losses in our natural capitals. We need to make sure that financial institutions change course and turn from brown to green models of economic development. We need to make sure that the transition speeds up. Distinguished guests, Hungary is very much committed to shifting its financial system and the entire economy to a sustainable path. Last year, MNB became one of the first central banks in the world to acquire a green mandate from the country's parliament, incorporating environmental sustainability objectives into our statute. This strong mandate will be instrumental in pursuing our green program that we had rolled out in 2019. Let me highlight very shortly some of the different programs and initiatives we have done so far. We launched the stress test to determine which firms and sectors would be worst hit by climate change. We issued green recommendations for credit institutions to ensure that their sustainability operation. We introduced a preferential capital requirement program that encompasses energy-efficient residential mortgages, green bonds, and renewable energy investments. We announced the Green Mortgage Bond Purchase Program. We launched a Green Home Program. We developed the Family Green Finances Program to help households find budget-friendly financial solutions that also support sustainability. We have been contributing to university education and research programs, banking and capital market courses. Most recently, we, together with the OECD and the EU Commission, launched a project to assess the financial risk related to biodiversity loss. This year, the National Bank of Hungary has started to review its measures, and we revise them as necessary. As green products become more widespread, more data are available, providing our bank with the opportunity to measure back our programs. We plan to continue to expand our extensive analytical toolkit and share our experiences with industry players. Finally, I would like to stress that the Hungarian Central Bank wishes to lead by example. As climate action starts at home, we wish to be at the forefront in the country when it comes to greening of own operation. For that reason, let me now invite you to join me in watching a short video footage of our WWF-approved habitat restoration project. The aim of the initiative that we founded is to compensate the CO2 impact resulting from our operation, including the footprint of this conference also. So I hope you will enjoy the conference. I hope you will enjoy the video. Thank you very much for your attention.
Deforestation towards a greener financial system. 50,000 trees herald the central bank's green transition. The Hungarian Central Bank was among the first in Europe to receive an environmental sustainability mandate as one of its core tasks. Magyar Nemzeti Bank promotes the green transition of the financial system through incentive programs, recommendations, analyses, and discussion papers. The Hungarian Central Bank intends to set an example for Hungarian financial institutions by reducing and neutralizing its own carbon footprint. The MNB has financed a reforestation project the size of almost 40 football fields in Gest in order to offset the impact of emissions from its own operations.
Mi hiszünk abban, hogy igenis van kapcsolat a Magyar Nemzeti Bank tevékenysége és a tágan vett környezeti fenntarthatóság között, és a jó hír az az, hogy úgy néz ki, hogy a kormányzat is hisz benne, hiszen egy zöld mandátumot adott a Magyar Nemzeti Banknak, melynek keretében a környezeti fenntarthatósággal is foglalkoznunk kell. És hát nincs ennél felemelőbb érzés, mint hogy azt láthatjuk, hogy kézzel foghatóan megvalósul az, amiről elméletben beszélünk. Tehát 100-150 év múlva reményeink szerint az a Gest melletti 25-30 hektárnyi erdőterület, amit tölgyessel beültettünk, az így fog kinézni. Ilyen hatalmas fák fognak itt megjelenni, ilyen hihetetlen környezet fog körbevenni.
Itt közel 24 hektáros természetszerű erdő kialakítását kezdtük meg tavaly év novemberében. Ősszel, makvetéssel elvetettük a területen a kocsányos tölgymagakat, utána erre gabonát vetettünk, azzal a céllal, hogy magát a gyomnövényzetet visszaszorítsuk, hiszen ezzel leárnyékoljuk, és valójában a vegyszer helyett mechanikus védekezéssel tudunk dolgozni a területen.
21. században igazából két nagy kihívás, környezeti kihívás van. Az egyik az a széndioxid és a globális felmelegedés, de a másik az viszont a természeti környezetnek a romlása. Tehát egy ilyen helyen azt lehet látni, hogy a faanyag, a növényzet, meg a talaj maga is széndioxidot köt meg. És hát, hogyha ezt mind összeadjuk, akkor lehet látni, itt egy óriási karbonraktár közepében állunk, ami nem mellesleg egy gyönyörű erdő. Az asszály elleni védelemben ez nagyon jól jön. Minél több erdő van, nagyjából lehet mondani, hogy annál nagyobb az esély, hogy helybe ki fog alakulni csapadék, és hát arról is nyugodtan beszélhetünk, hogy itt ezek a talajok, ezek hihetetlenül gazdagok, nagyon jó tápanyag körforgás van benne.
Aki környezettudatos és jobban odafigyel a környezetére, az pénzügyileg is tudatosabb. Íme a Magyar Nemzeti Bank karbonlábnyoma 100 évvel később.
Mr. Kandrács, thank you for your welcoming remarks. This video was really impressive. Before we start the keynote presentation, we have video message from Frank Elderson, member of European Central Bank's Executive Board, sharing his opening remarks.
Dear Governor Matolsi, dear conference participants, many thanks for giving me the opportunity to say a few words at the 4th International Green Finance Conference organized by the Magyar Nemzeti Bank, even if speaking to you remotely via this pre-recorded video message. The first edition of this conference was held by the MNB in late 2019. Back then, the network of central banks and supervisors for greening the financial system, the NGFS, had just published its first comprehensive report. This report was a call to action for central banks and supervisors, a call to action in acknowledgement that the physical risks and transition risks from climate change and environmental degradation are a source of financial risk, and that as a result fall squarely within the mandates of central banks and supervisors to ensure that the financial system is resilient to these risks. At the time of this 4th International Green Finance Conference, this is now the global consensus. And with the statement released by the NGFS earlier this year, acknowledging the materiality of nature-related financial risks, this global consensus indeed covers explicitly both climate and environmental risks. The call for action has been heard by an overwhelming majority of central banks and supervisors around the world. It has been heard by the now 116 member institutions of the NGFS. The NGFS that, as of COP26 last year in Glasgow, is no longer just a coalition of the willing, but a coalition of the committed. Committed to contribute to addressing the climate and environmental crises. And that call has been heard by the Magyar Nemzeti Bank, that has been a member of the NGFS since early 2019 and has been hosting this annual conference ever since. Likewise, it has been heard by the European Central Bank, the institution that I represent as an executive board member and the vice chair of the board responsible for banking supervision. The institution in recent years has been consistently integrating climate change and environmental considerations in all its tasks and responsibilities by adopting an action plan to incorporate climate change considerations in its monetary policy, by issuing a guide of supervisory expectations for the management of climate-related and environmental risks by the institutions that we supervise, and following up consistently to ensure that they will live up to our expectations, by walking the talk in our non-monetary policy-related balance sheet management and in all our operational duties, and by evaluating and revisiting our actions to ensure that we stay on a path that is consistent with EU legislation implementing the Paris Agreement. For us, this concerns a strategic commitment, by which I mean it applies irrespective of where we are in the business cycle. It is clear that central banks and supervisors are not the primary actors responsible for addressing the ongoing climate and environmental crises. Central banks and supervisors are climate and environment policy takers, whereas governments are climate and environmental policy makers. Governments in the European Union are clearly committed to Paris. The European Union is taking concrete steps in implementing legislation that puts this into practice. Central banks and supervisors cannot ignore this in the pursuit of their mandate. Similarly, we cannot ignore scenarios in which along the way to Paris there will be an increased manifestation of physical risks from climate change and environmental degradation. All this implies that we cannot deliver on our mandate assuming a status quo. And by rejecting the status quo as the baseline for the future, we become a force contributing within our mandate to the transition. As I voiced before, finance alone cannot make the world green, but greening the world without finance is impossible. I wish all of you an inspiring, productive, and importantly, green International Finance Conference. Thank you.
Ladies and gentlemen, after the welcome remarks, the first keynote speech of today's will focus on the challenges of keeping the momentum behind green finance. Giving the first presentation is Mr. Thomas Steiner, Executive Director for Treasury, Human Resources and Accounting in the Oesterreichische Nationalbank.
Thank you very much. Thank you very much to the Central Bank of Hungary for having me, and thank you for this invitation. I'm very happy to speak now about the year of the unprecedented challenges, how to maintain momentum in green finance. The outline of my talk will be, first I will talk about the unprecedented challenges, so the war in Ukraine, the energy crisis, inflation challenges, the climate crisis and its continuation, but also the blow up against the ESG hype. And then, obviously, after presenting all the challenges we are facing, I will also talk about some solutions that are given in the market, but that are especially given by central banks to solve these problems or to face these challenges. But before I start to talk, I want to give a little tribute to the National Central Bank of Hungary. You are a real leader in green finance among central banks, and I'm very happy to see this and also to have learned this, to be honest. When preparing this presentation, you're presenting a very honest and careful reporting standard, which is also an example for us, and we want to follow this example. So this is very good. You have, and you also mentioned, or you already mentioned it in your opening remarks, that you have set some very creative initiatives to support green finance. And with your experience and energy, and also with this conference, I think many of central banks, but also of the market, should follow you. I also wanted to highlight one thing that you already also mentioned, is your energy efficiency mortgage program that you offer. But now let me start with the year. You said it will go into history, the year 2022, with its unprecedented challenges and its implications into green finance and the things we are talking about now. Obviously, the war is the last thing we need. And the question is, does it have to step back for the sustainability? The war puts UN Sustainable Development Goals in grave danger, obviously. The Russian war exacerbates other crises. You see the COVID-19 pandemic. We are facing a food and energy crisis. We have a lot of challenges in climate change, but obviously in news and in government actions, you see a lot of challenges or actions on the war and on its fight against the implications that are coming with the war. So obviously this conflict has to end, but on the other hand, we should not forget about the tasks we were having before the war started, and the goals we set ourselves, and we should not lose focus on. Then, obviously, there is this energy crisis, which was there already, but with the war, it accelerated. And over the last 12 months, global energy material prices have risen a lot. I highlighted here gas prices and material prices, which almost tripled. And this has an it has an impact on the net zero transition. And in the short run, it's obviously bad, because some things have to step back. This transition cannot continue as we already planned it. Obviously, for example, in Austria, we're still using coal, or we reinvent coal, and we're importing natural liquid gas, or we try to do it to have enough energy in Europe. So in the short run, this is a step backwards, but in the long run, I think this will accelerate our path to this goal that we have to move into net zero economy. And obviously what's happening is that the uncertainty, it rises, and this is a risk, and this is very important for us as a central bank. This is a risk for the financial stability. So what we see is we have warflation, and we ask ourselves, what does it mean and how can this go on? And when we talk about warflation, obviously we get to the second big topic of this year. This is inflation. This is the main task, or the main responsibility, or the central responsibility of central banks to keep prices stable. And obviously, we are facing here a very big challenge, and the European Central Bank has already shown big actions. Not expected actions. Some say they come late, but they come very clear and they come very expressive, that we follow our primary objective, which is the core of our mandate. And here we see, I put the graph on with the inflation development over the last 2 years. And there we see, obviously, energy is a big driver of this inflation, but it's not the only one. And obviously, with time going by, these energy prices that have risen, they will move into all the other components of inflation. So the problem of inflation will get bigger or broader. And so what we see now is something like, I just said warflation, but it could be also named as fossilflation, and it should not be named greenflation. Greenflation is obviously the transformation from carbon prices and demand for renewables within a short period of time. Then this can rise prices as well. We see this, but it's just of minor implication into inflation. What we see here is that the energy prices, they put big pressure on it. The ECB, as I already said, has put a very strong response on it, and we will fight inflation, or the European Central Bank will fight inflations, and financial conditions are getting already tighter. But this also has a very big implications on growth. We see the risk of a recession, but if it will happen, then we are confident that it will be not a very severe one. The next crisis we are facing within this year, it was also already very clearly mentioned by you, Deputy Governor, is the climate crisis. We see extreme weather events. Not all these extreme weather events can be directly linked into climate change, but they're not only climate related, but a lot of them are climate related, and the big proportion of it are. So the frequency that we see, this is obviously due to the climate change, and it is only the beginning, as you already said, of what we will see within the next years. So this puts us back to what we said already before COVID and before the war. On our agenda is saving our economy and saving our environment by fighting this climate crisis. We also face a lot of physical climate risks, and they directly transform into financial risk. And this is where central banks and also supervisors come into play. And our primary goal is, or our recommendation is, measure your risks and manage them. What we also have seen in the last year is, I quote here 2021, we saw a rapid growth in ESG finance. So green finance, everybody was emitting green bonds, and if you see presentations from asset managers, they present you what they are offering or what they are doing, how they are reporting on green finance. This topic has obviously moved from niche to mainstream. The size is quite big. I don't know whether it's really 35%. Of the market. But then what happened in 2022, there we saw a lot of stocks and bonds that are related to brown economy. They performed quite well, but the green finance, they had bigger losses than the main market. This is the graph on the two graphs on the left side. This shows how stocks worldwide performed. The red one, obviously, it's quite negative, but even more negative is green SRI-related stocks, equities. And in the graph below, you see that within the last 3 years, yes, it was good to invest responsibly, but in this current year, so year to date, we see a move in the other direction, which is obvious when you are in the energy sector, for example, and you produce oil or gas, then you made high profits this year. And this will not go on, obviously. There is a big warning sign on the highway as well. What we also saw this year is greenwashing scandals. I quote here DWS, but also Bank of New York Mellon and ExxonMobil. We see these greenwashing scandals, and they also put this topic in question. So what we think now is green, is it really green? And what can regulators or what can banks, what can the economy do to put transparency on it? Report on it, talk about it, put light on the dark spots, and I think this will avoid future greenwashing scandals. What we need is an open debate about the impact, and we need more transparency to have a smooth transition so that financial stability is here. I already said that this market of ESG bonds and reporting is growing enormously. It used to grow in the year 2021 very, very fast. It's still growing, but the pace of it is coming down, so it's a little bit slower. I quoted some numbers how the net money that is into this market went a little bit down. So the report I found was 32 billion net new money in the second quarter of 2022. Okay, now I was talking about all the challenges we are facing and what we are seeing now. And now let's talk about some of the possible solutions or the possible fields of action that the central banks, that we can set, that the economy can get into. First, I want to start with the EU regulation. With the European Commission. It was already said, not only by the Deputy Governor, but also by Frank Elderson, in the driving seats are obviously governments and supranational organizations like the European Commission. And we already saw that big progress, but the work is not done yet. So we see progress on the taxonomy, on disclosure environments, on standards, and so on. I think Europe leads there, but others work there too. And there are, I found out that there are some 30 different taxonomies worldwide. And finally, perhaps it's not necessary to have one taxonomy, but this number of taxonomies will have to reduce so that the market easily understands what is green and what is brown and how can we deal with it. We have to avoid confusion, for example, but not only for the financial materiality, but also the EU looks in the other direction. So not only what does the economy do and what has it for implications to the environment, but also the other way around. So this is a double materiality, obviously, when there are 30 different taxonomies, I think that some kind of global coordination is needed. So it's necessary to have networks and talks and conferences like this one, so that it puts the players together, so that they start to talk and develop new ideas or find a common ground to work on. I was talking about the taxonomy, and let me put there some Austrian remark. We think that the taxonomy is useful, but Austria does not support it blindly. So we have a big and open discussion in Austria with the Commission. We think that nuclear and gas, obviously they are responsible for lower carbon output than coal and oil, but I think they should not be marked as green. This only transitional, and in Austria there is a big common sense that I think this is in Hungary perhaps something different, but let me stress it. I think that we see this green transition not only towards greenhouse gases, so we are also very critical to nuclear energy, and this is why the government said it will stress find jurisdictional ways to fight against this taxonomy. The Austrian government will lodge a complaint at the EU court. If this is successful, then only the complementary delegated act will become void, and the rest of the taxonomy will survive. I think that the European Commission already incorporated this in this framework. They had the idea, or they thought that some countries could oppose against some parts of it, so they put it on a different table, and Austria is on this different table. We think that gas and nuclear energy are not taxonomy compliant, or should not be taxonomy compliant. What we should also do is we should foster ESG transparency. This is on different levels, and if we are successful to foster this transparency, then we will put more business confidence in it. I think the TCFD made their very good recommendations, and I am happy, and it was already said before, that the National Central Bank of Hungary already follows these recommendations. The Austrian National Bank will follow this example as well in little steps. So for the year 2023, we will for the year 2022, sorry, we will report in the beginning of 2022 on our non-monetary policy portfolios in euros, how the carbon footprint, how large it is, and other main key performance indicators. And we will also do it, as I will talk later, as the Eurosystem will do it, we will talk about some little monetary policy portfolios as well. So we are happy that the TCFD made here clear recommendations, and I think we should follow those recommendations. It should be honest. So it will be to your own disadvantage if you try to make it nice now. At the end, I think truth will come up, and so it's good to be honest now and to show a path for the future. If you have good reasons, for example, to follow in one of the recommendations not the TCFD, then you should explain it. I think this is good governance and good practice if you do this. And you should also describe the way forward. It's not only a table that you publish on some figures that could be interesting, but it should also underline what are your thoughts about it, what is your strategy behind it, and what is your what is your way forward, what are your goals in green finance. I think this is important, and this will improve your reporting, and at the end it will improve the market and will help the economy in its stable transformation into a better future. It will put confidence in the market, and it is a reliable source of information for this smooth transition. Frank Elderson said it very clearly. There is the network for greening the financial system. Austria, the Austrian National Bank, is also a part of this network. We are contributing actively there, and we are happy to do so. The key areas are supervision, so supervision of banks, obviously. This is an important thing, but also on monetary policy portfolios, on monetary policy, your own investments, so the non-monetary policy portfolios, and about your own corporate operations, which might seem to be rather small compared to, for example, monetary policy portfolios. But nevertheless, I think you should lead there also with as an example to the market. What can we do, or what do we do on our own portfolio? Or on our own tasks, on our own building, on our own relationship towards people that work within the Austrian National Bank. I think we should lead as an example. This does not necessarily mean that we have to be ahead of the curve, but we should not move faster than the market, but we should be supportive and we should be a leader in the sense that we report on it, we are honest, and we give away all these anxious that's in this market or in this reporting. We put on the table what we think that it is, and we give a good example how people could act. And obviously, and this is part of this being honest, we have to take this criticism serious. I think it's very important as a central bank to say our primary target is price stability. And it's not the primary target to make the economy green. And this is also what Frank Elderson said. We are policy takers in this green world and not policy makers. There are the governments who are in charge. Nevertheless, we take it very serious and we put into place what we can do. We have to stick, this is a second point of criticism, we have to stick to market neutrality. This is important for especially European Central Bank, and we take this very serious. And we have to check, and this is a reference to what I showed, how the performance of ESG bonds or SRI bonds and equities was year to date and within the last 3 years. We have to check the costs, but the costs are not only, well, it has had a worst performance year to date, but it's also the cost versus inaction. So what will happen if we are not putting the things on track to move into a net zero economy? It's very important to have a dialogue also with the private sector. For example, this conference is here a good example and a good opportunity to foster this and to improve this. But not only the private sector, but obviously all other political actors. What does the Eurosystem do? I think I put together a little portfolio of actions that happened. Obviously, it's much bigger than what I put on these slides. For example, let me take out some points. The corporate bond purchases. There we have a gradual decarbonization as of 2023, which will start. So for those who are reading the slides, it should exchange the top two parts of this little cake. About the collateral framework, which is obviously very important for banks to get liquidity from the central bank, the eligible collateral must fulfill the corporate sustainability reporting directive, which will start then to be eligible, the collateral in 2026, so there's still some time ago. We are limiting our risk of high carbon assets also in the monetary policy portfolios. So there's a big high number of actions that the European Central Bank does within its monetary policy portfolios. And we follow there the recommendation of the TCFD, and we disclose our data on corporate bonds, as I already said, in the beginning of 2023, where we'll disclose this information. But not only we will disclose it, we also put a tilting bias into a green tilting bias into the CSPP program, so that the buying of bonds that are green is more favorable than others. This has already started this week, as we have as we are in October 2022 now. So this was on the European level, so the European Central Bank, what they do. Let me talk now very briefly what the Austrian Central Bank does already since for our own policy portfolios, so the non-monetary policy portfolios, our own investments, the reserves that we manage. What do we do since 2012 already? For the external managers, we obliged them to sign the UN principles for responsible investments. This is a very broad task, so it's not only green, but it's also the socials and governance aspects that are incorporated there. And we put requirements on greenhouse gases emissions for selected asset classes. For example, we obliged people, or our mandates there, to beat the benchmark by 10% in terms of lower carbon emissions, and we asked them, or we obliged them, to exclude companies that are involved into ESG controversies. I think these are first steps. It's not the end. I'm honest there. But I think this is necessary, and it's good in this transformation. This transformation has to be a stable one, so we should not move too fast, but obviously we have to move faster than we do it now. This is not the end, what I was talking about now. So we are already setting new initiatives in it. We put the firm sustainability criteria into our investment process. So we redesigned our investment process, and we are integrating ESG criteria more broadly into our reporting framework. This will come out in 2023 when we have our first SRI report, and we will invest more in green and sustainable bonds. The Euro system also assesses, as I was talking about supervision, assesses also climate risks in the financial sector. I think this is very important. This is not always a task for central banks, but very often a task of central banks. So the Austrian Central Bank followed the Hungarian one by putting up this climate stress test. I think this is a very good initiative. Also for the banks to know their own risks. As I said it in the beginning, look into your risks and manage them. You can only manage them if you look into them. And the climate stress test is there a very good example how you can improve your knowledge of your own portfolio. You have to collect data. You have to stress this data and see what the outcome is, and then you will obviously take action to avoid big risks that are in your portfolio. One of the big risks we saw on a country level is our dependence of a lot of countries, Austria, Germany, but also Hungary, on energy that is coming from Russia. Now we feel this risk very severely. I think it's important to know about your own risks and then to take action for a smooth transition. We already, or there was a climate stress test published in July, and I already said these things. And I also put a quote here by Frank Alderson, which will make him happy, hopefully. Okay. Then what do we do as a company? As the Austrian central banks, we have 1,200 people working in our bank. We have more or less one big building. So we also want to move, as an example, lead by example here, and I put the statistics we are collecting since the year 2001 on greenhouse gas emissions, and I tried to explain it, what happened. It was a drawback in the years 2012 following that we put on a cooling into the office. Nevertheless, we could manage to come down, yes, within the last 20 years, really significantly, from 6,000 tons to now below 1,000 tons. I think this is a good we are moving in the right direction, but we are not there because it's not net zero yet. We are also thinking, and we already did this in the past, to buy or to compensate this. But nevertheless, I think compensation is something good, but it's even better to avoid it directly. So this is why we set different initiatives. And we are EMAS certified for now over 20 years. And this is a very good exercise for us to look at our own situation and to try to improve it every year by little steps. And this is what we do now over the last 20 years. And the results you see by a really declining path of CO2 emissions. Nevertheless, central banks, this is our responsibility to be active there, but nevertheless, the real action comes from carbon prices, obviously, and there the primary responsibility is within governments and parliaments. So the Austrian government, for example, they put first steps already before the war started, put first steps on how to incorporate carbon pricing into all the economy, so that in the long run we are not facing fails prices, but we are getting more honest picture of our economy and the risks we are facing. This obviously now is adding some pressure. For example, in Austria, the introduction of carbon pricing was a little bit shifted, but nevertheless, this puts some pressure on inflation, which is now very hurtful, but nevertheless, it's only a little proportion that's going on. And I think it's a good thing to do. And the last point here, I think it's rather to carbon tax than emission trading, because it's too volatile and it creates uncertainty for the business. You see that on the chart that carbon prices not only moved up a lot, but they also have become much more volatile. Yeah, the time is running out. I put on here a little quote by Bill Gates and the bathtub. The inflow of CO2 into our economy is constantly, but it's coming lower. Nevertheless, at some point, the bathtub will overflow. It's our task to avoid this overflow. So this 1.5% goal that we have to keep in our mind, it comes closer, and delaying this process, as we already saw, is very expensive and it amplifies costs. So action is needed now, and it's needed very clearly. This is not an excuse for future actions. We should not only hold very interesting and remarkable talks at conference, but we also should put this into action in our own companies and on fields of responsibility. Let me just summarize some of the key takeaways that I was talking about. First, this climate and the climate and transition risks, they are materializing. We saw the big challenges we are facing in the climate, in the financial markets, in the energy prices, in inflation. We need huge investments to speed up this transition. One boost of this is just coming by the speed of transition within an economy that is less dependent on gas, for example, from Russia. I think that central banks should support the smooth transition within their mandate. I think this within their mandate is very important, but it's also our mandate to support it. The fiscal policy, so the prices that are set, or the environment for prices that is set by governments, this must boost incentives, and I think this is already done, but it's not already there. And I think, this is my last point, greenwashing could be a problem, but what we can do against it is transparency. Transparency also for first of all for us, so that we get the clear picture, but also for the broader public. That puts people or that gives people more confidence in green finance. I'm very happy that you listened to me. Thank you for the invitation once again, and I'm ready to take questions or remarks. Thank you very much.
Thank you, Mr. Steiner, for your valuable thoughts. Our second keynote presentation is about the transition challenges the corporate sector must face. Please welcome to the stage Mr. Pepin Reivers, Executive Vice President at the World Business Council for Sustainable Development. In his role as Executive Vice President, Mr. Reivers focuses on the redefining value pillar of WBSCD's strategy to improve decision-making and external disclosure, eventually transforming the financial system to reward the most sustainable companies.
Thank you very much, Deputy Governor, Mr. Steiner, honorable ladies and gentlemen. Thank you for inviting us for today's conference. I'm joining you today from my home in Amsterdam, so I hope that you can all hear me. Next slide, please. So, the World Business Council for Sustainable Development, or WBCSD for short, is a premier global CEO-led community of over 200 of the world's leading sustainable businesses, working collectively to accelerate the systems transformations that are needed for a net zero, nature positive, and more equitable future. We do this by engaging executives and sustainability leaders from businesses and elsewhere to share insights on the obstacles and opportunities they face, by co-developing guides from these insights, by providing science-based targets, including standards and protocols, and by developing tools and platforms like the Greenhouse Gas Protocol to help leading businesses in sustainability drive integrated action to tackle the climate, nature, and inequality challenges across all corporate functions, sectors, and geographical regions. Next slide. So, in the past, our society has seen several large-scale, big-impact transitions, typically driven by innovations. For example, the Industrial Revolution or the Digital Revolution that started in the 70s and is still ongoing today. During these times, new businesses emerged that created value in a different way, in several cases replacing incumbent businesses. Many businesses have had to build new competencies in order to adopt their business models and operations so that they could stay relevant and competitive. Today, we are, again, in the midst of such a large-scale, big-impact transition. A transition this time not driven by innovations, but by a perfect storm of challenges in the form of climate emergency, nature loss, and mounting inequality. Next slide. Just ahead of Climate Week in September, Johan Röckström from the Stockholm Resilience Center made clear that 4 of the 16 natural tipping points will tip over at 1.5 degrees warming, or within 8 years at the current rate of global emissions. This basically means that 1.5 degrees is not just an ambition, but a hard planetary boundary. Ongoing geopolitical conflicts also emphasize that climate action is no longer just a scientific consideration for Earth systems, but that decarbonization and low carbon energy is an increasingly important geopolitical consideration for energy security. Next slide. Similar to how the trillions at stake from the climate inaction is increasingly accepted by mainstream financial actors, so too is nature loss. A new report from Moody's Investor Service warns that 9 sectors that affect or depend heavily on natural assets could face nearly 1.9 trillion in credit risk due to mismanagement of these resources. In a report published last year, the World Bank outlined the potentially devastating consequences of inaction from an unprecedented decline in biodiversity, with roughly 1 million animal and plant species at risk of extinction. Next. Increasing inequality is also a systemic risk, one that weakens and threatens economies and social systems in a number of ways. In fact, according to the World Economic Forum 2022 Global Risks Report, social cohesion erosion is perceived as a critical threat to the world across time spans, both short, medium, and long term, and is seen as among the most potentially damaging for the next 10 years. At the same time, we do have a final window of opportunity to correct our course. Next. We are seeing transformations across all sectors and countries. What this means for business is that sustainability has moved from the realm of why and what to do to a question of how to do it. How to decarbonize, how to become nature positive, and how to contribute to an inclusive and equitable society. Next. Now this brings opportunities and threats. Opportunities around how to create new ways to drive customer value and competitive advantage. How to keep the business positioned for success in a fast-changing and unpredictable operating context. On how to engage with capital market players so that financial incentives for accelerated innovation and transformation are in place and the desired timelines can be met. These how-to challenges require collective action because the scale of transformation required is too large for any one company to do alone. Next slide. And at the same time, a business as usual scenario is no longer a viable option, as it is more and more economically risky, environmentally dangerous, socially unacceptable, and legally challenged. Next. So, in the context of the conference topic of today, I want to dive deeper into transformations that businesses face today. Transformation can be described as the act or process of changing completely. In this visual representation, the various stages of this process are described. Incumbent businesses develop path dependency through optimization, while other businesses start to experiment with alternative ideas, technologies, and practices. And over time, pressures build on business to transform, leading to destabilization as alternatives start to accelerate and emerge. The actual transition is then chaotic and disruptive, and new combinations of emerging alternatives and transformative elements grow. It's in this process that elements of the old business model that do not transform are broken down and phased out. This is an example of a process in which new technologies and considerations drive new business models that replace the old ones. In the example of fossil fuels, without innovations that mitigate the negative externalities that they produce, they are likely to phase out over time, while renewable sources of energy are in the process of growing their application and are likely to become the main source of energy at some point in the future. And this obviously is an example of such a transformation. Next. Now, let's consider 4 large clusters of transformations that are happening today. Climate and energy, a transition towards net zero, voluntary or potentially mandatory, and under huge time pressure. This is potentially one of the better understood transitions. But we also have materials and circularity, as access to raw materials becomes pressured and Earth's ability to regenerate at the rate of extraction is undermined. Circularity presents itself as a necessity and a solution, optimizing resource use to meet society's needs while allowing the systems that provide resources to regenerate. Nature loss and biodiversity. Nature is a vital ingredient in ensuring healthy people, healthy business, and a healthy planet. Yet it faces challenges such as mass extinction rates and pressure on land, water, oceans, climate, and biodiversity, with increasing difficulty to feed and house our global population. And lastly, labor practices and supply chains. Systemic inequality in our society is inherently unscalable, value destructive, and must be addressed to enable all people to lead healthy, productive, and dignified lives. Trends towards decent labor practices across the value chain of production, implying paying a living wage, ensuring safe working conditions, and respecting human rights are visible. These are all large clusters of transformations, and they also interact with each other. Next slide. So, how can we best look at businesses in the context of these transformations? Let's consider a very simple model to understand the interplay between transformation on one hand and valuation on the other, and ask ourselves 3 questions. Question A: which part of a company's long-term value potential is exposed to a particular transition that I just mentioned? For instance, one way to think about this is that sectors that have large negative externalities and at the same time high substitute availability, they have a high transition exposure. Then question B: what is the likelihood of a given transition to take place? And obviously this depends a lot on your operating model and how you are geographically dispersed, but all 4 transitions will probably hit your business model in one way or the other. Then question C: what is the company's, or what is your adaptability to a given transition? Meaning, to what extent can you respond to the change, adopt your processes, products and services, and protect your value creation under transformed circumstances? For instance, a company can anticipate societal trends in its markets by building competencies to learn about and serve these new societal needs as part of its strategy. Or, of course, it can also bet on a business as usual assumption. Now, from a risk management point of view, we would simply multiply A times B times C to understand the future value at risk. But these questions also allow us to understand the difference between the long-term value potential of a business under a business as usual assumption or under a full transition assumption, meaning where the transitions that I mentioned have completely taken place. From this, it then becomes clear that the adaptability of a business has large implications for its long-term value potential. Next slide. Here we consider an example of the transition in the mobility sector, where we see the complete phase out of the combustion engine and a full adoption of electric driving. Tesla is ahead in its capabilities and can quickly scale up its production capacity to serve increased demand. Volkswagen is behind and catching up at a high cost. The difference in capabilities is summarized in a Bloomberg article titled "Volkswagen's boss warns the troops, we don't want to end up like Nokia." And I quote, "Volkswagen is at a critical juncture. It has electric cars rolling out, but it is well behind Tesla. And it has massive manufacturing skill, but desperately needs to rethink its vehicles as rolling software devices. It is in this last issue that CEO Herbert drives home with Volkswagen's more than 635,000 employees. The transition in competencies from industrial might to software prowess will be an immense challenge for automakers that are vast, deliberate, and some say ripe for disruption. Car companies that get it wrong risk ending up like Nokia, failed hardware makers doomed by more nimble and technologically adept upstarts." Now, in this example, it clearly shows that starting early on a transition curve creates large amounts of uncopyable advantage. Currently, Tesla's market cap is 10 times that of Volkswagen. Now, whether this is correct or not, it gives us a proxy of the value of the adaptability of a business under a given and significant transformation. What is quite clear is that it's a really big number. Next slide. So, In order to increase the adaptability of a business under the transformations mentioned, businesses will need to develop the competency of managing the sustainability of their business model and operations. And this covers all functions and all decision processes. Risk management needs to quantify and value transition risks across the operating model of the business and across the transitions that they are likely to have the highest impact. Existing governance, management accounting and auditing controls need to be strengthened so that new and potentially non-financial elements can properly be included, assessed, measured and assured so that investment-grade decisions can be made. Treasury and investor relations need to collaborate with their financial counterparts to establish the right level of support and buy-in. The implications of relevant transitions will manifest themselves on every element of the business: brand equity, customer acquisition opportunities, loyalty, talent attraction and retention, to name a few. Today's challenges are poorly understood. All this work requires the development of standards, protocols, measurements, transition pathways, a common language, and so on. Now, if I ask a group of CEOs whether they believe that digitalization or the internet has had a profound impact on their business and the way that their business creates value, they would probably all say yes. If I then ask if they believe that they are really good at digital, not many would agree. And this is because developing new competencies takes a long time and significant investment before you discover what it can mean to your specific business case and your specific context. So it's paramount to start early. It's paramount to start with all corporate functions, and it's paramount to start today. Next slide. Now, let's look at the role of the financial system. In the disclosure space, there have been developments in mandatory disclosure against frameworks like the TCFD and efforts in global standardization of ESG through the ISSB. And it's quite likely that we will see mandatory climate-related disclosures in over 50 countries within 3 years. Scope 3 accounting methods are being developed and will have to be included. Nature is following fast, with TNFD, the Task Force for Nature-Related Financial Disclosures, gaining traction. There is significant momentum in this space, and the time is now to leverage that momentum to move towards a sustainable finance policy environment that supports transparency, evolution of concepts of fiduciary duty, and strategic approaches to evaluating externalities, including a consistency across jurisdictions. We know that banks and investors are increasingly focused on plans for the transition to a low-carbon and climate-resilient future. This transition will require an enormous amount of financing and collaboration. The work and the growth of GFANZ is a testament to this. The recently published Real Economy Transition Plans by GFANZ provide a helpful framework for the components of rigorous transition plans and strategies by companies. The framing from GFANZ calls on companies to provide disclosures on low-carbon R&D, CapEx, the provision of low-carbon products and services, and the impact of each low-carbon product or service on achieving greenhouse gas emission targets. As we have seen, the identification, assessment, and management of transition-related risks and opportunities is a key competency for valuing and an investment decision. Valuation tools are increasingly incorporating non-financial forms of capital into decision-making, going beyond negative screening. More and more asset managers are compensated and incentivized based on long-term financial and non-financial performance. There are several concrete commitments to eliminate carbon emissions from portfolios by actors like those in GFANZ, the Net Zero Asset Managers Alliance, the Net Zero Insurance Alliance, and several others. There's commitment from UN PRI investors to develop a more sustainable global financial system. Now, these are large-scale initiatives representing the world's largest investors, asset managers, and hundreds of trillions of dollars of assets under management. So the next big and maybe most important conversation will be on the impact of new disclosures on the capital allocation and valuation models, so that those businesses that lead the transformations are rewarded with a lower cost of capital. Without this incentive, we will not unlock the transformations at the scale and the time needed. In reorienting capital towards value creation versus value extraction, the power of innovation and entrepreneurialism is focused on where it is today needed most. Next slide. In summary, we all need to start early, building the sustainability competencies within our businesses and organizations to be able to make decisions in an integrated way, driving innovation and resource allocation to position the business model for a world where the transitions have become a reality, while the financial sector assigns appropriate value and incentives for those businesses, products and services that speed the transition to a net zero, nature positive and equitable world. Now, how can we help? At WBCSD, my team seeks to help establish the valuation model of the future so that sustainable decision-making is rewarded and, at the same time, enables sustainability competency building in core corporate functions so that sustainable decisions can be made. In order to achieve real impact, we work directly with key corporate functions at businesses to jointly develop a change agenda driven by their needs. We have a Cfo Network, which is the first community that we have built with this objective in mind. And in 2022, the network has grown to over 55 CFOs from multinationals participating across industries, and with work streams around financial systems architecture, capital market engagement, reporting and disclosure, TCFD reference scenarios, and building out the S in ESG. So for those of you who would like to engage with our work, please send me a message. And with this, I would like to thank the MNB for their leadership in this space and inviting us for today. Thank you and have a great conference.
Thank you for your inspiring presentation. Ladies and gentlemen, we will take a short coffee break now. We continue 15 minutes. Thank you. Ladies and gentlemen, we continue today's conference. Next up, the MMB Green Finance Award Ceremony 2022. I would like to ask Deputy Governor, Mr. Csaba Kandrács, to give his opening speech for the ceremony and present the awards.
Yes, thank you very much, ladies and gentlemen. In 2019, the Central Bank of Hungary has created a tradition, the Green Finance Awards, to recognize the most environmental conscious financial service providers. We strongly believe that we need to inspire the financial institutions to support the green transition of the economic system. You know, as a supervisory authority, we have stick and carrots, and now we're talking about rather the carrots than the sticks. Similarly to the previous year, the winners of the Green Finance Awards have been determined by a number of quantifiable indicators to assess the greenness of financial institution activities. The award will be granted in 3 categories: the Green Bank Award, the Green Insurance and Pension Fund Award, and the Green Investment Fund Manager Award. In case of banks, the metrics determining the winners were based on the green lending activity, the climate risks of the loan book, and the greening dynamic of institutions. In case of insurance companies, pension funds, and investment funds managers, the criteria rely on the managed ESG or green funds. All of the awarded institutions have shown dedication to green finance in their activities, performing as the greenest institutions in their own sector. I would like to congratulate to all the winners, and let's see who they are.
So, the first presented category is the Green Bank Award, and the winner of the award is the Raiffeisen Bank ZRT. Receiving the award is Mr. György Zolnai, Chief Executive Officer of the bank. Please, Mr. Zolnai, come to the stage.
Thank you very much. In the name of our 3,000 colleagues working here in Hungary at Raiffeisen, it's a huge honor to receive this award. And also thank you very much for giving us a few minutes to say a few thoughts on being a green bank and what we have done. I thought of preparing a few slides that list the actions that we did, and if the colleagues could help move to the next page. And there are 2 pages of actions which I expect you would be very excited to read and remember. But then listening to all 3 of our banking supervisors, of course, the National Bank, then also through Thomas Steiner, the Austrian National Bank, and seeing the video from the ECB Executive Committee member, I thought, in addition to maybe quickly touching on these, I will mention 2 other thoughts. One, what is it that we did that might actually really allow us to deserve this award? And finally, to ask for a little bit of help and raise a concern, if I can. So on the first one, I will not list it, maybe just to mention that probably all the banks set up committees, probably all the banks are in buildings that reduce their carbon footprint. I cannot imagine a retail bank that did not sell the ZOP. It was the best product. And of course, all the fund managers have introduced ESG funds. So then what is it that maybe put us in front of the list? Deputy Governor Kandrács mentioned the 3 criteria. And I think in terms of the bank side, probably what helped was that we actually took this task very seriously. Not just for us, but for our customers. So probably what allowed us to have the largest green portfolio, or to have the biggest volume of green assets, are some of the actions you see at the bottom of the page. We worked with our clients to educate them about how their bonds, their issuances, their loans can become green. And this is what had the impact. At the end of the day, we're just a bank. We have relatively low carbon footprint. Our clients are the ones who emit, who either build projects, do infrastructure, continue with their processes in a forward-looking green way or not. So our impact was, for example, helping the first 4 green issues. Ourselves as a bank, we were the first to issue an MREL bond that qualified as green. And through this, I hope we had the impact. Now maybe let me move to the concern. If we ask ourselves, how are we doing? Are we on track to save the world, or at least to achieve the Paris goals of reducing carbon emissions? I'm afraid that my concern is that we're not doing well at the moment, and we have somehow got ahead of the regulation and the requirements, and we have left our customers behind. Hopefully this is a thought that's reflecting on what the ECB Executive Board Director was mentioning, and also Thomas Steiner, in the sense of ESG blowback, some concerns around greenwashing, and potentially lack of transparency. My contribution or request from the front line, I think we banks are a little bit closer to the customers who are doing the real emission. The request from the front line would be, let's do a little bit more focus, and let's have more transparency and accountability. If we achieve those things, then eventually our regulations will have the impact of reducing carbon emissions. Maybe just looking back, I now have more than 30 years of experience in the banking sector. We have had a history of initiatives where the sector was helping or was used to achieve various goals. For example, anti-money laundering, or FATCA, or various tax or regulatory assignments. Some of them worked well, some of them didn't work so well. And I think the difference is always the weakest link in the chain. So if the ESG declaration or the emission certificate that the customer is able to issue is transparent, is accountable, is according to standards that a year later can be requested from the management, rather like a financial statement or a tax declaration, then those standards will have an impact. If we try to do too much and do not focus on the transparency of those, then at the end of the day, we might not achieve. Thank you very much for your patience, and huge thanks for receiving the award. Thank you.
Thank you very much, Mr. Zolnai. Coming up is the Green Insurance and Pension Fund Award, which has been awarded to Union Vienna Insurance Group Biztosító ZRT. The award is received by Mr. Attila Mészáros, member of the board at the institution. Please, Mr. Mészáros, come to the stage.
Here to the place. So, thank you very much, Deputy Governor, honorable guest speakers, ladies and gentlemen. It is my honor to be here. Thank the National Bank of Hungary and the award committee for appreciation of our efforts at the Union Insurance Company in the field of sustainability and green finance. Currently, sustainability and green finance are hot topics, and everybody talks about these issues. However, it is a challenge to put the theory into practice. The corporate strategies generally to address ESG principles and make people aware of this concept, for example, green finance. Nevertheless, value of a corporate strategy depends on the actions that we can implement into our day-to-day business. At Union Insurance Company, we put a great emphasis on supporting green finance and those companies that are engaged in the green industries, and we also support the green bond issuers. We express this commitment by launching and distributing the Union Green Trends Balanced Unit Fund, making the green option available for our customers. In addition to, we believe that green finance is not the only one area where we can promote sustainability. The recent Digital Welfare Patent Award Union Insurance received acknowledged that we focus on digitalization as part of we implement paperless office procedures in all our operations and so on. But before sharing some details about the Green Union Fund with you, I would like to look back to the past, to my personal experience. At the end of the 80s, when I worked on my thesis at the university, the environmental protection equaled to political radicalism. As a result of that, we missed the opportunity to find the right balance between technical development and environmental protection. And a long way since the Danube Dam-related demonstrations in 1986 in Budapest, where we said simply no to an environment-damaging investment, we had to learn how to accommodate the technical development, business achievements, and adopt environmental considerations. Because just saying no to something we learned is not a solution. Over time, we find a more complex approach, as ESG, for example, in which we integrate environmental, social, and governance perspectives as well. As a result of that, technical and social development can take place in a sustainable manner. So just let's talk about a little bit about our fund. This fund offers an investment for clients who wants to participate in the development of global area, green and ESG bonds, as well as equity markets performance of companies that recommends solutions to the major social problems. The next slide, please. Maybe I can. No? Okay, anyway. The composition of the fund includes, thank you. The composition of the fund includes Hungarian state bonds, green bonds, government securities, equities of companies engaged in the renewable energy sector, equities of water management sector, euro green bonds, circular economy promoting companies, decarbonization promoting companies, and so on. The purpose of the fund is to make available such an investment for mainly retail customers with whom we serve investment products. So, and finally, let me to conclude my talk by thanking you again for this award. I'm very happy to be part of this inspiring professional event. At Union Insurance Company, we committed to continue our work on green finance and all actions related to developing and implementing ESG principles. Thank you very much indeed.
Thank you, Mr. Mészáros. The next award presented is the Green Investment Fund Manager Award. The awarded institution is the Raiffeisen Befektetési Alapkezelő ZRT. I would like to ask Mr. Péter Simon, Chief Executive Officer of the Investment Fund, to come to the stage to receive the award.
Thank you very much, Mr. Deputy Governor. I'm really proud and happy to be here, and I would like to thank you, of course, to the National Bank of Hungary and to all of my colleagues in Budapest and, of course, in Vienna. Please go to the next slide, please, if it's possible. Now I would like to briefly introduce what we are doing and how we are doing. I have to say that the Raiffeisen Group itself has a long-standing commitment to green finance and to ESG issues. We are, RBI is a member and signatory of many organizations and green initiatives. So it's not only a fashion for us, as I said, it's really a long-standing and very severe issue. To the next slide, please. Very briefly, what stands ESG for? It's environmental, social, and governance issues, and we at Raiffeisen created this so-called Raiffeisen ESG score, to tackle all of these diverse issues and to deliver a very good performance. To the next slide, please. How we do? We have a so-called three-pillar approach. First, we try to avoid what we think is not an investable universe for us. For example, weapons, thermal coal, and similar, let's say, negative issues. On the second level, we try to support what we think might be good investment and is viable to support. It might be thematic investing, where it's more concrete issues, or impact investment, where we deliver even more direct impact. I think it's a very important part of the whole investment process, of the whole ESG process, the engagement. What we call engagement. We are there at company meetings, with the company dialogue, corporate dialogue and continuous dialogue. We have like an analysis, a table, how much we participate and what we do, what we deliver. I think if we, as an industry, let's say investment industry, we put together the resources and vote in the same direction, we can influence the companies, the activities of the companies, and we can reach let's say, the green goals. The next slide, please. What we did, as I said, we have created this ESG scorecard, which means that we deliver not only examine the sustainable issues, sustainable criteria, but we also examine the financial criteria, and we try to invest on the top, let's say, of this scorecard. Sorry, and so we are convinced that we are able to deliver the good performance. To the next slide, please. This is in more details. Of course, we have a sustainability team in Vienna. It's basically at least as big as the equity or bond investment teams, and they cooperate very closely and put together a portfolio using the Raiffeisen ESG scorecard, which is let's say, it's a time-proving exercise now. As you say, as I said, we do have, let's say, from the side, the engagement and voting policy as well. Yes, we can go to the next slide, please, if we have. And that's my very last slide. As I said, we are really committed to the ESG and don't consider it as a short-time fashion. We have on offer 4 funds, and we are working on the 5th fund. And what I have to tell you, even during this, let's say, troubled times, we have a stable investment and stable assets under management of these funds, which shows for us that not only us, but the clients also have the long-term commitment towards ESG. Thank you very much.
Thank you, Mr. Simon. Congratulations to the winners. With this, we close to the part on the Green Finance Award to financial institution, and we turn to the MNB Sustainable Finance Scientific Award. The winner of the awards have been decided by a high-level jury, the Green Finance Scientific Council, invoked by the MNB. The jury is composed of outstanding scientific experts and members of MNB's Monetary Council. The jury members are Mr. György Matolcsy, Governor of MNB, Mr. Csaba Kandrács, Deputy Governor of MNB, Mr. György Kocicki, member of MNB's Monetary Council, Mr. Gustav Bager, former member of MNB's Monetary Council, Mr. Őrs Szatmári, chairman of the Sustainable Development Committee of the Hungarian Academy of Science, Mrs. Diana Ürge Forsac, vice chair of Working Group 3 of the Intergovernmental Panel of Climate Change, Mr. Péter Kaderják, head of the Zero Carbon Center, Mr. Péter Halmai, scientific director of the Sustainability and Competitiveness Research Institute at the Budapest Metropolitan University. Let me invite again Mr. Kandrács to introduce us this new initiative.
Thank you very much. The question could be why we are doing this as the central bank, and not just as a central bankers, but as it was mentioned, other professors, that we try to facilitate the green finance researchers. Because it is a very young platform in the Hungarian academic research, their results are of great importance to the evolution of this new scientific field, and we would like to accelerate all of these researches. By founding these new awards in 2021, our aim was to incentivize academic capacity building beyond the green financing by supporting the researchers and motivate scholars to find new ways enhancing sustainability. The main profile of these awards is green finance, but I would like to also highlight the interdisciplinary aspect. Sustainability cannot rely on only financial tools, thus the following researchers and research projects also demonstrate various approaches. I sincerely hope that our awards will serve as inspiration for the whole green finance research community, and that we are contributing to the development of education and science related to sustainable finance with our initiatives. And now, let's see who are the winners.
Thank you, Mr. Kandrács. Now let's see the category by category, this year's winners. The first category, International Green Finance Lifetime Achievement Scientific Award. The winner this year is Professor Sean Kidney. Sean Kidney is professor in practice for sustainable finance at the SOAS Center of Sustainable Finance at University of London. He is also the CEO and co-founder of the Climate Bonds Initiative, an international NGO working to mobilize debt capital markets for climate solutions. Sean is a member of the European Commission's high-level expert group on sustainable finance and the UK government's Green Finance Task Force, co-chair of the India Green Bonds Council, and a member of the Mexico Climate Finance Consultative Board. He is the climate bonds representative on the China Green Finance Committee and has published several papers on how to grow green bonds in China. He has also been a consultant on green bonds to the United Nations Secretary General, a member of the People's of Bank of China Green Finance Task Force, and a member of the Commonwealth Secretariat's Expert Committee on Climate Finance. Since today, Sean is hosting the Asia Regional Climate Bonds Conference in Singapore. He couldn't join us in person, but he is here with us online, and we will give this presentation after the lunch break. The next award on the agenda is the Green Finance Scientific Talent Award. The award goes to Mr. László Vértesi. László Vértesi is an assistant professor at the Department of the Finance at the Budapest University of Technology and Economics, and associate professor in the Department of General Administrative Law at the University of Public Service. He is a lawyer and economist, thus this research often combines these two approaches. His research topics include circular economy, financial law, and business cycle. This year, we may celebrate 4 awards for new research initiatives in green finance. The jury decided to deliver a special award and 3 ranked prizes to the scientists based on their submitted research plans. The special award goes to Elvira Böcskei and her research group. The research idea is based on the following question: how to real estate sector may become more competitive and sustainable by answering the economic crisis. Their target is to identify types of companies related to green bond issuance. Thank you, Elvira Böcskei, Dr. M.S. Molnár, Dr. Ilyesné, and Dr. László Nagy. Other members of the research group: Dr. Veronika Fenyves, Dr. Zoltán Bács. The third prize of Green Finance Scientific Research Initiative goes to Antal Kovács, assistant lecturer at Neumann University. In his research plan, Antal aims to conduct a feasibility study which demonstrates the potential of creating a business group responsible for the assessed management of the national natural wealth. This creative approach offers a directly applicable research output which may ameliorate the environment. Thank you. The second prize of Green Finance Scientific Research Initiative goes to Áron Horváth and his research group. This collaboration developed a research plan which may analyze the statistical linkages between the energy performance of buildings and real estate prices. They plan to carry out this research based on Hungarian data, which promises useful theoretical results for policymakers and banking system as well. Thank you, Áron Horváth, Antal Ertl, and Zoltán Sápi. Other members of the research group: Monika Bene, Gergely Mónus, and Gáborné Székely. The first prize of Green Finance Scientific Research Initiative goes to the research group of the Knowledge Center of Circular and Economic Analysis at the Hungarian University of Agriculture and Life Sciences. Their research focuses on the financial resilience of agri-food business in relation to climate stress. To work pursues is one of the most pressing issues in a high climate exposure sector, which is a key to preserving food safety of the country for years to come. Thank you to Kitty Anna Mária Bognár, Boglárka Bozóki and László Vértesi, other members of the research group, Tamás Havadi. The Central Bank of Hungary hopes that all these research plans will soon reach their targets. For this goal, the Central Bank of Hungary is open to cooperate with the researchers. Our colleagues will contact the researchers with all the details after this conference. Congratulations again to all winners. Please keep up the good work on the green research. Ladies and gentlemen, we will have a lunch break now. We will continue the conference at 1:30 p.m. Have a great time. Thank you. Dear ladies and gentlemen, as a continuation of our conference, Professor Sean Kidney will give his presentation as the winner of the Green Finance Lifetime Achievement Scientific Award. After the keynote presentation, we will move on to today's first panel discussion. Since today Mr. Kidney was hosting the Asia Regional Climate Bonds Conference in Singapore, he couldn't join us in person, but he's here with us online. Professor, the floor is yours.
Thank you so much. Thank you so much for inviting me. Thank you so much for the honour, I have to say the extraordinary honour, of the prize, and of course the honour of just the collaboration. I'm going to say that it is one of my joys speaking with the Hungarian Central Bank, because we have a central bank that understands the challenge and wants to attempt solutions to it in a way which I'm keen for other central banks to learn from. While in Singapore, I've been advising the Monetary Authority of Singapore, who are now moving on climate issues, following in the footsteps of the MNB. I've also been talking today at the Hong Kong Monetary Authority, similarly doing great things. The smaller economies of the world have a lot to show the larger economies of the world. But in this case, I want to talk to you about those larger economies of the world, the risks that we face going forward as a result of climate change, which is my area of focus and what I've been speaking to people in the region where I am now in ASEAN. We have, as you know, very severe risks. We've seen in this past year drought, extraordinary drought in some places, like Pakistan, before the flood. I spoke to someone in Islamabad 2 months before the floods who were talking about wells being dug to 400 metres deep because farmers were running out of water instead of the 40 metres deep. I had similar conversations in multiple countries around the world, starting in India. And then suddenly a third of Pakistan was underwater, knowing that water should have been trapped in the mountains of the Himalayas into ice and snow for rain in winter. It won't be, it's gone. It's not trapped, it's not protected, it's not put into reservoirs, it's not usable. This is a looming disaster for Pakistan. Not only will the monsoons fail 1 year in 5, the glaciers are moving very fast, they disappear, they're melting, which means Pakistan loses the reservoir it has had for millennia to create civilization. Remember, the Indus is one of the great baskets of civilization on this planet. We now know that civilizations were there at the same time as they are springing up in Mesopotamia. We risk losing a lot at the moment, including creating violence and conflict, and I'm afraid to say, mass movement of peoples. We think the 1 million people from Syria trying to cross the water is a problem. We have seen nothing in relation to the mass movement of peoples we can expect if we don't address these kinds of risks. It's not just, of course, in Pakistan and Sichuan, in southwest USA. It's even in Vancouver, where a staff member of mine, not so long ago, when the heat dome was up there, was phoning me in 47 degrees Celsius heat, saying how she was trying to find a place to put her 2 young toddlers in an air conditioning so they could escape this suffocating heat that was there. Vancouver! Unbelievable. She found a place. Luckily, the grid did not collapse. In other places, when we've had climate extremes, like in Texas with the snow, the grid collapsed as everyone turned on the heaters and people froze to death in their homes. It isn't just heat we have to worry about. It's not just the physical impact of floods, of drought, of heat, of wildfires that we've seen so much of over the last couple of years. It's also the social impacts, the immigration, of course, the outages in economies. We've just had an experience of a biodiversity ecosystem collapse impact. It's called a pandemic. It was about bats being forced out of ecosystems in southern China and Southeast Asia, colonies come together, pathogens jumping between species, and then to humans. This is what happens with climate volatility. This has been predicted by the IPCC Health Committee for 30 years now. We can expect more And in a sense, we have to understand this is an impact of humans changing the environment, drastically changing the environment. Until we get on top of this, things are going to get worse. Unfortunately, because of the latency effect of greenhouse gases, the climate change we are now beginning to feel in a severe way is through emissions we put in the atmosphere in the 1980s. We put in more emissions in the last 30 years than in the previous 150 years. So we are going to see, even if we stop emissions stone cold tomorrow morning, 30 years of increasingly severe climate. That we are now consigned to. Now that will mean floods on the Danube one year and drought the next year. That is, it'll become unnavigable, as the Rhine has been over the last month. We will see changes to agricultural production in the rich agricultural lands of Hungary. There will be drought, things will dry up, as they happened in Russia in the steppes in 2010. And you might remember that in that year, Russia banned all exports of wheat to the rest of the world, which led to a spike of food prices, quadrupling of wheat prices in many countries that had to hedge their exposure 4 times in Tunisia, Libya, Egypt, and Syria, and revolutions arising. In fact, the French Revolution was preceded by 2 years of crisis in agriculture, and wheat prices were 4 times the normal price in the 2 years of that revolution. These are indicators. We've just been through a price spike because of the war in Ukraine. That's gone down, but it might go up again. These are challenges for us. Essentially, this is all about risk management. There is risk of direct impact on our societies and a flow-on impact on our financial stability. In fact, a flow-on impact, one would say, towards capital destruction, in the words of the Institute of Actuaries in the United Kingdom. Stability is, of course, the mandate of the central bank, financial stability. As the Network for Greening the Financial System has made very clear, the kinds of headwinds we are going into are not conducive to the financial stability that is the mandate of central banks to deliver. In fact, rather the reverse. We face some very substantive risks. There's all risk. Nothing's certain in life. It could be hit by a meteorite tomorrow and then this is all academic. Or we might find a way to solve it. Maybe Elon Musk will come up with some kind of fantastic new toy that'll solve the world's climate problems. But I wouldn't place my bets on it, and certainly if I'm a central bank, I'm obviously, like the MNB, not placing a bet on that. We do need to understand in more detail that risk if we are to know what actually to do. Unless we understand the severity of what's potentially going to happen, we will not take the commensurate steps. If we think the Danube is going to rise a little bit, drop a little bit, we will build modest flood walls. If we think it's going to rise meters and meters and drop meters and meters, it'll have a very different kind of physical investment program as rising. That's the reason why the climate science input into our understanding of financial sector measures to take is utterly essential. Utterly essential. So in the physical side of it, we already know that drought, heat, and so on, and water problems are alive. We are aware of the social impacts, the health impacts coming through. We need to invest in our health system to ensure we can survive pandemics, for example. Insurance losses globally are already up 66% in the last 20 years. Insurance premiums, reinsurance premiums specifically, flowing on to insurance, are rising but not adequately. The profit margins have been squeezed in this period. There's some changes to be made which will have an effect on the cost of insurance going forward as a reflection of the physical impact. What we can say, though, is that we are tracking way worse than anyone expected, and therefore we need to act with much more alacrity than expected. There is another sort of risk that is very pertinent now, which I'm going to say is the risk of policy impact. Not adequately understood, but to give you an example, in 2001, the German government passed a feed-in tariff. This was a significant step instituted by the German Greens, which led to large-scale offtake agreements essentially for renewable energy. A booming German renewable energy industry arose. The cost as a result of solar and of wind dropped like a stone. The primary driver of cost reductions in things like renewable energy and electric vehicles and other sorts of new technologies is volume. It's not R&D, it's volume agreements, it's offtake agreements. That's the secret of hydrogen, by the way, green hydrogen. We've in fact seen now that story picked up by the Chinese in 2006, and ever since then, China's been the largest investor in renewable energy every single year. It was again last year. That has created a vast Chinese renewable energy manufacturing industry, which has driven down the unit cost that we are all benefiting from around the world. Solar in the US now is so cheap that Republican counties who are banning the term climate change from public servants are building solar and abandoning gas because it's cheaper. That's where we've got to, thanks to strong state action some time ago. Well, there's other state action around. Electric vehicles, thanks to, again, China, with its strong state mandate for the development of vehicles. 20% of all cars last year sold electric vehicles for air pollution reasons at first, and now for climate reasons, and of course, energy security reasons. I'm in Singapore now. They have 1,000 ships a week moving through the straits here, a lot of them of oil. Easily blockaded, I realise, by the US 7th Fleet. China's oil flows here. They don't want to have a risk of being blockaded by the US 7th Fleet. They like the electric vehicles. So it happens to coincide with their climate policy and their air pollution policy. We all know policies don't have one driver. They have multiple drivers. The impact of that, though, has been a drastic reduction in the cost of electric batteries over the last 15 years, driven by mandate in China. Tesla has benefited from technologies coming through that haven't been there before. In fact, all electric vehicle companies around the world are seeing massive prices dropping for the cost of production, in a bumpy kind of way, depending on supply chains. What I can tell you, though, this is a problem for the Hungarian auto industry. You've already seen the mandates for BMW and Mercedes and Volkswagen in particular to go electric. They've invested hugely in battery manufacturers. The Hungarian auto industry, huge as it is highly dependent on petrol-based chassis, petrol-based vehicles. Many parts manufacturers will suffer unless Hungary can find a way to create industries and create industrial developments that respond to this change that's coming through. Understand the change and respond is the secret. Well, in the last year, we've seen significant understanding of the change, appreciation of the risk of change, with the commitments for 2030 emission reduction, not 2050, 2030 by all the world's major economies. At the Biden Climate Summit last year, preceded, by the way, by the European Commission, who started this, we've seen 2030 commitments by Japan, by Korea, by, of course, the United States, by Canada, and so on. The word amongst investors now, globally, and I speak to a lot of investors, is that the shape of the future is now very clear. They believe it will be clean and green. The only uncertainty is the speed. Will the speed, well, first, be adequate to meet the IPCC's requirements of 50% cuts by 2030, or will governments fudge that? More to the point, though, who will win and who will lose? Is green hydrogen really viable? Should I bet on that? Which kinds of solar companies? Have I got to go to China to invest in solar? Or will that new startup in India backed by the government make money? These are the decisions that are now vexing investors. This is a huge change in a few years' time. The green revolution, and let's call it that, is now a field of extraordinary opportunity for investors around the world. Scary, because it's volatile and lumpy. It's more like the surf at a beach than a calm lake. But nevertheless, that is where attention is focused, absolutely. And in property, of course, there's risk too. Everyone believes that there'll be further work done to drive energy efficiency in buildings. This is why, of course, the MNB's risk-weighting support for green property bonds is so important as an incentive to the market, because we need to get people to start thinking and acting accordingly and investing in the sort of property that at the very minimum can be avoiding future negative policy steps. The Netherlands Central Bank has passed a regulation saying that banks are no longer allowed to lend to very inefficient buildings. Banned entirely. They can't carry them on their books. You're going to see a lot more of that sort of thing, possibly from the MNB, but let's see. Negative as well as positive. Sticks as well as carrots. The solutions for all of this, from a technical perspective, are well understood. Some are differentially priced. Green steel is about 30% more expensive, for example, than the high carbon steel at the moment. That isn't stopping Mercedes and Volkswagen investing in the Swedish green steel production plants, because the actual extra cost at the car level is 1%. That's a marketing cost. And they will be selling their cars as zero carbon steel-based cars. The electric ones, probably, not the petrol ones, not so good for the Hungarian industry. But nevertheless, you can see how these things are going to change. I said earlier, the secret to cost reduction in solar and in hydrogen and other areas is volume production. Offtake agreements drive that. And that's exactly what's going to happen in steel. I expect green steel to be the same price as ordinary steel very quickly, compounded by the fact that in Europe, 70% of all steel plants are coming to the end of life in the next few years. There's a vast capital agenda involved here in changing what we have to actually do. We've proven that people will invest if they are given risk-yield investments that are broadly similar. That is a caveat, I would agree. But the green bonds market has been growing like nothing on earth. We now have some $2 trillion of green bonds outstanding, from $2 billion when I started some 10 years ago. And on top of that, we've got the related, the daughters of green bonds, social, sustainable, and so on. Of course, the MNB has been actively supporting this growth. I've got a couple of slides I'd like to show you. If you could call up the first one, that'd be wonderful. The capital investment we require is about $9.2 trillion a year, according to a lecture I heard a couple of days ago from McKinsey. It's a big capital lump. Of course, 2/3 of that can be repurposing existing capital flows. So there's an extra capex lump of about 1/3 of that, 3.5 trillion. Think of it as the difference between a gas plant and a solar plant. Gas plant is lower capex, higher opex. The solar plant is all high capex and extremely little opex. To make the transition, many, if not most of the investments we have to make have a high capex profile. The operating costs will be lower, as they are for electric vehicles, for that matter. But there's nevertheless a capex penalty. Luckily, we have more than enough capital in the world. We are blessed that way. And when we deliver that capital, next slide, please, we have extraordinary receptiveness to these kinds of investments being displayed by investors. Not only in development bank bonds, it's the European Investment Bank that issued the first such instrument. We're very proud to be European citizens as a result, from my perspective. But also corporate bonds and sovereign bonds. The European market has seen a plethora of sovereign bond issuances, including by Hungary, which have been very successful. Hungary's done 2 currencies now. The European Commission sovereign bond, some 10 billion euros so far, has achieved price advantage on the basis of 10 times oversubscription levels. This is an extraordinary, fast-growing market. Next slide, please, if I may. Of course, what we can see very clearly, that when we start factoring in the risks ahead of us, non-green bonds are going to be seen as more risky and more affected by the changes. Green bonds are, in a sense, more resilient. One of the things that we have to do. Next slide, please. I've mentioned the pricing benefit that we're seeing here. Strong pricing on buildings in the secondary market. Green bonds hold their value. when there are a downturn in the market. Even sustainability-linked bonds, for all their problems, get a greenium. When the secondary markets freeze, they did in March 2020, green bonds stay liquid. It's extraordinary. In fact, in Europe, we have this extraordinary situation where in the real estate sector and the utility sector, more bonds are green than are not now. This shows the future for the rest of the world. This is a very optimistic signal of the kinds of changes we are seeing happen. What have we got to do to make this change? Well, we need to be clear, as I said earlier, about what it is we have to do. Understand the severity of the ambition. There are some critical differences when we understand that severity. In Japan, for example, the industry is thinking of, the steel industry is thinking of investing in gas. But if you look at the emissions reduction, this is instead of coal to replace them in the blast furnaces. But when you think about what we have to do, unfortunately, gas is not commensurate with the emission reductions we have to achieve. You need to be looking quickly to hydrogen. A big job now is to sort out the dependencies of hydrogen, get the price down, so we can convince the Japanese as they replace their blast furnaces to go to hydrogen. In China, this is the case too. 78% of blast furnaces in China are coming up for refinancing before 2030. Of course, this is a big opportunity if we get the CapEx decisions right. We need guidance. This is where taxonomies come in. We have in Europe, as you know, developed a really important contribution, which is the taxonomy and sustainable finance. And mea culpa, I've had a lot to do with it. It's not over yet. It looks complicated. I understand that. It'll become easy. We're now working on usability over the next few months. These taxonomies have gone viral. China has one. In Singapore, we've been helping the government do one. Colombia, Chile, Canada, India, etc. Shopping lists for the future make it easier for the financial sector to understand what to do without having to get involved in complex scientific calculations. That taxonomy has to be extended to transition investments, those steel plants where companies are shifting to low carbon, for example, or chemicals or other sectors. We need to be looking and adding to this taxonomy resilience, because as I said earlier, we've lost, well, I implied we've lost the fight against climate change, because we have. We will now see severe climate impacts getting worse from now on. We've got to prepare. We're still in a race to fight, stop catastrophic climate change. We need to be looking at entities assessing companies and governments to understand whether the ambition of what they're doing is adequate, giving them the opportunity to issue bonds, to issue all sorts of investment instruments to finance their solutions. The Chilean government has done a sustainability-linked bond, for example, linked to its climate targets. Yes, Chile, we will see a lot more of that. But we do need to understand whether the targets are adequately ambitious. I'm very happy with the Chilean bond. I would be anxious, very anxious, if some of the other countries like Mexico issued one, because government policy is at the moment not consistent with the Paris Agreement targets. So a sustainability-linked bond linked to government plans would be a problem. Getting those kinds of benchmarks and reference scenarios in place applies to the corporate sector as well as the government sector. While sustainability-linked bonds have been booming, there's about 200 billion of them outstanding now, I'm going to say 3/4 are very weak in their claims. We support the market, we just want rigor. And we are working on more of that. The second area of work, which is something that the Hungarian Central Bank, the MNB, is working on, is around incentives. Risk weighting and the capital ratio requirements of banks for green property bonds is a fantastic initiative. I'm so excited to have been able to talk to the bank prior to that. But of course, there are other things. In China, the People's Bank of China has discount capital available at the wholesale lending window of the central bank if a bank posts green bonds as collateral, 1% discount, fairly substantial. In India, the Reserve Bank has included green investments in the public sector lending requirements. Banks must lend a percentage of their programs to green to make this work. The USA, in the recent Climate Act passed by the Biden administration, is replete with tax credits and guarantees and subsidies. That's one way of doing it. Europe, of course, has the CBAM, the Climate Border Adjustment Mechanism, coming through. Whilst I'm always uncertain about penalties being a driver, the threat of penalties is very potent. The other side of that has to be to open up green trade windows. If we do see the creation of green steel in Korea, Japan, and in China, we should be allowing them preferential access here and blocking access and raising tariffs if necessary to high carbon steel. And that should apply to everything in taxonomies. There's a lot to be done. We've seen Valdis Dombrovskis talk about this and extending the idea in Europe in different sectors. And we use this as a way to protect those companies and those farmers, those entities in Hungary and in Europe who are making the changes, so they're not disadvantaged by high carbon investments from other countries and their support in different sorts of ways. We need, above all, pipeline building. We need to imagine what we need to do. Of course, the Recovery and Resilience Fund was meant to be this. I appreciate Hungary is not benefiting from that at the moment. I expect that to change in the near future. It is biased strongly, rightly, correctly so, towards green investments and resilient investments. A third green, the other 2/3 have to be resilient. This is exactly what we need to be seeing from governments around the world. Investment programs, support programs that ensure we are building the right kind of economy, society, infrastructure for the future, for our children who will have to live in it, and avoiding the wrong kind. We need to imagine what Budapest will look like in the future, and it will be different. There will be, of course, flood protections, better flood protections against the increasing up and down that we'll see in the Danube. But it will also be much more energy efficient buildings, especially in the context of the crisis we're having now, but also for climate change reasons, which will lower our energy bills. That'll be positive. It needs to be denser, better public transport and walking and cycling kind of urban environment. It needs to have more trees, because we are going to see in summers days, weeks, sometimes months of 30 to 40 degree heats in Budapest. We need to have much even greener streets than we have now, because they lower the ambient temperature by 5 degrees, and so on, and so on, and so on. And we need to be thinking of wealth. As we have these climate shocks, how can we ensure people are wealthy enough and have the kinds of livelihood that they'll be able to bounce back from a crisis from quickly, whether that be a pandemic or a flood? How do we do that? This is the art. Hungary has the opportunity to be the laboratory for Europe and the world. It is a manageable, compact, well-organized economy. If it embraces the challenge and looks to solutions quickly now and trials them, as the central bank has been doing, then it has the opportunity to show other countries in Europe and the world the sorts of things that work. This is what we need now. I will say, admittedly, I've been having the same conversation in Ireland and in Singapore. I think the smaller countries of the world have the chance to do things the large countries can't, because they get caught up in legacy industries, in conversations and so on. We have to act with alacrity. We have to create demonstrations. We've got to show the world what to do. But above all, we have to run, not walk. Urgency is with us. Time to act. And always remember that McKinsey's report I mentioned, it says $9.2 trillion a year. That's an incredible opportunity. Can I just go a couple of slides ahead to last slide, please, to finish up? Keep going. Keep jumping through. You know, I know we're making some progress on, just back one, taxonomies. We're making some progress on tilting to green. We can do more on blended finance, national transition investment funds and things like that. If we make progress on imagining and creating urban development, agriculture, including urban agriculture, and we channel the capital that wants to go green adequately, I think we can create a 30-year investment boom. I think we can create, through that, wealth and jobs everywhere. We can create a society that will be able to be more resilient in the face of the shocks coming through. That is the prize before us, the opportunity. Please, Hungary, show us the way. Thank you.
Dear Professor, thank you for your great and impressive presentation. Ladies and gentlemen, now it's time for our first panel discussion. To begin, introducing the topic is Mr. James Vaccaro, Executive Director of Climate Safe Lending, an international multi-stakeholder collaborative dedicated to accelerating the decarbonization of the banking sector. I invite Mr. Vaccaro to give his online presentation.
Thank you. Great to be joining you. Thanks for the introduction. Just check that you can see my screen if I share. Yeah, my name is James Vaccaro. I'm a career banker, and I'm mostly going to be talking about banking in the context of climate transition plans. I was a director of strategy for a bank for over 7 years, and one of the co-founders of the UN Principles for Responsible Banking. My job now, as introduced, was Climate Safe Lending Network. I'm also an advisory panel member for GFANZ on the Transition Plan Task Force. And as a strategist, transition plans are all about strategy. A little bit about the network. The network is bringing together people from within banks, investors, companies, campaigners, experts, academics and regulators from across the world. So it's genuinely multi-stakeholder to figure out how can we nudge the things to go further and faster. We particularly kind of focus on the thinking which goes ahead. So in introducing this next discussion on transition plans, trying to give a few thoughts and provocations as opposed to only just looking at the trends in terms of what's being regulated and is mandatory. A little bit of our work there you can see and follow a bit more. First of all, what is a transition plan? As Sean just said, what we are going to be experiencing, in the words of one scientist, is hotter hots, colder colds, wetter wets, and drier dries. The entire economy is going to be under a huge amount of stress. And we can look at what the plan is. Well, what is it? How are we going to deal with it? Well, it's how to deal with the problems and how to contribute to the solutions. These two lenses of materiality, both essential. On the one hand, the financial risk and opportunity, the single materiality lens. How do we understand the direct micro-prudential consequences? Because there's going to be losses. There's going to be a lot of financial stress and tension as a consequence of the damage which we know is already locked in and is potentially going to spiral more. And how do we contribute to addressing the shared systemic challenges? And here there's the sort of the ghost of Stuart Kirk from a presentation earlier this year, who sort of mentioned, well, HSBC has got an average loan tenure of 6 years. So why should we care as HSBC about what happens in year 7? If you're a central banker, you should be really concerned by that statement, because from a financial stability perspective, you're owning that responsibility of the shared systemic challenge, and therefore how banks are collectively contributing to the solutions and addressing more than just their micro-prudential consequences is of utmost importance. So, a little bit about where transitions sit within the process. This is something from a bit of climate safe lending documents called Taking the Carbon Out of Credit. You might start the process, if you are a bank, in saying, well, where are we now? Can we do some measurement to baseline where we are and then set targets? Well, there are tools from PCAF, the Partnership for Carbon Accounting and Financials, which benchmark and baseline how can you get a sense of your financed emissions, your scope 3, the most material element of your transition. And then Science-Based Targets Initiative being able to ensure that those targets made are really science-based and are sufficient. You then have to, what we suggest, take three take three. Oh, Sean, I think you're on not on mute. Take a three horizons approach to the actions that you must take. So you put in place. Sorry. Short. Others on the line are not on mute. Thank you. So looking at how do you translate these targets into actions is through transition plans. It's a strategy process. So you look at what might you be doing in terms of addressing the things which are causing the most damage, the first horizon of legacies which need to be exited in the right way. How can you translate all of the current portfolio to a safe landing and to invest in new solutions? And you activate that strategy, and you have to keep on using it as a learning loop. It's an active document. Like the great philosopher Mike Tyson says, everyone has a plan till they get punched in the mouth. Scenario selection. A little bit about, well, where do you set the guidance to be able to set your targets? Well, in the AR6 report of the IPCC, we probably only have about 400 gigatons left forever in terms of the carbon budget. This was from the beginning of 2020. It's probably around 290 gigatons now. So at current rates, we've got about 7 years of those stocks remaining. This implies how essential it is to make those cuts early in order to give ourselves a longer pathway. What we realize at the moment is that, well, some banks who have set net zero targets, part of GFANZ, are maybe thinking about leaving because the race to zero criteria, saying 1.5 degree scenarios, is too stringent. When we look at it though, and this is from a mathematical perspective, if everybody sets their own 1.5 degree target and based upon a 1.5 degree scenario, those scenarios are quite different from one another. And you might end up potentially overshooting in aggregate the carbon budget by some distance. So this is going to be something which is going to put even more pressure to cut even faster than the current goals and ambitions of banks. There's also, well, do you make targets which are based upon intensity targets or absolute targets? Is it about the green proportion, or is it about the real reduction in harmful and in emissions? As you can see here, if only what you do is reduce intensity, you still are on course for something which is way beyond safe limits. It requires not just allocating to new green, all those new green bonds and climate bonds, but also proactively reducing flows to harmful activities, therefore reducing absolute emissions. It means looking at scope. It means being able to understand the entire supply chain of carbon right the way through a balance sheet. In money laundering, every bank is subject to KYC, know your customer. You have to keep on going past. If there's more shell companies, well, you need to look through that and get to the root of it. We need an effective KYCO2. We need an effective way of being able to screen through all of the financial intermediation to get to the ultimate client emissions. We did a report called the Carbon Bankroll, which was looking at corporates financed emissions, companies like Apple who have 200 billion on their balance sheet, company managing sustainability well, a company that's just realized that they finance through their cash on their balance sheet more emissions than every single Apple product that is made, distributed, sold, recycled every single year. So we know that the transition plans are going to become mandatory. This is from the UK government, one of the first mandatory frameworks. It is building upon existing frameworks, ISSB, TCFD, being informed by the guidance from GFANZ. So there's a lockstep of different organizations determining what are the ingredients that need to go in them. But beyond what ingredients need to go in them, what's going to make it a good transition plan? That was the starting point for the network when we drew together our stakeholders in being able to say, well, what can we draw from recent literature, stakeholder expectations and best practices? in terms of what we need to become credible, good enough. Well, it needs to be sufficient. The scenarios need to be science-based. It needs to be viable. Are we assuming that we can do this? Are we actually putting the capex into these new technologies, or are we potentially falling foul of green wishing risk? In other words, well, maybe somebody else will be able to capture and store our carbon, or maybe somebody else's assets will be stranded, not ours. And then it needs to be turned into commitments, real cash against the things which are going to make a difference. And when we talk about disclosure, transition plans are a communication tool. We've already got hundreds of pages. We don't need hundreds of pages more if they're just going to minimally comply. We need them to have an intention to inspire, to inform, and to initiate real change. So how are we going to make sure that those disclosures are drivers of the change that we need in the real economy and between the relationship between banks and clients? And that starts by banks having relationships with all of their stakeholders to actually decide what is it that makes most impact. And that's something that stakeholders need to be involved in, because, well, as EY reported recently on TCFD reporting, either banks think that climate change doesn't have as big an impact as it could, or they're just honing in on certain aspects of climate risk which they feel more comfortable at the expense of everything else. So we need to have a balanced process. And then needing to look at, well, what are all the elements that a financial institution or a bank can actually play in being able to drive the transition? We've broken this down in our document, the Good Transition Plan. We give specific tools about how to run like a climate crisis away day. And I'll go through some of these examples, but a lot of them center on what are all of the elements of what a financial institution can do beyond just the allocation of money. Banks have got lots of different hats. It's not just the providers of money. Bankers are policy influencers. They're sounding boards and advisors for clients. They're product structurers. They aggregate and make sense of data. They're brokering relationships and market shapers. How do you bring all of that within a strategy context to optimum effect? Well, with a client, if you're looking at how to retrofit, say, a historic building in the center of Budapest, perhaps, how might a bank play an active role in being able to connect up its network, to be able to broker partnerships, be able to sort of have some peer learning in order to drive the business development, to be able to drive the capacity through the supply chain, and then offer the right sized financial solutions to those clients? Lots of good examples of that coming through. In being able to structure financing. This is one of my favorite projects. It's in the UK called the Chancery Lane Project. When looking at how to structure things, there's an open source resource for specific covenants and conditions that could be dropped into financing documents for all different types of purposes to assist the transition. Both GFANZ and the Race to Zero talk about needing to align their lobbying and advocacy strategies, part of persuading. Here you see there's the implementation, the direct implementation, and also the more indirect engagement strategies. When we look at it though, the Transition Pathway Initiative says that at the moment, the climate policy engagement alignment is about 0.6%. So basically no bank is aligning their climate lobbying with climate goals. There's one bank which discloses all of its trade association memberships. There are new standards in responsible climate lobbying. How do banks call for the right types of carbon pricing, carbon reduction mechanisms and policies which are going to increase the pace of transition? And that will include financial regulation. The one-for-one rule, which is in some of the CRR amendments in the EU at the moment, suggesting proposals in Pillar 1 changes to specifically re-engineer capital pricing for the expansion and exploration of fossil fuels. Just today, there was a report studying the UK, whose licensing of oil and gas exploration in the North Sea might exceed the entirety of the UK's carbon budget capacity. So the risks of that potentially being stranded by a future administration become quite high, therefore underpinning a prudential risk to those types of assets. Not only is this being discussed in Europe under CRR, it's also being proposed elsewhere, including the Canadian Senate. When we look at the transition, we're needing to look at not just the net zero pathway, but also how does that role get played out in the real economy? What's the delta in the real economy? Not just cherry picking things which are good already, but the improvement to energy performance of buildings, for example. However, we shouldn't get too hung up on saying, well, we can't just do paper-based decarbonisation, we need to do whole economy transition, when what we see too often is that when we see some of the high impact sectors at the moment who need finance to transition, the actual degree of low carbon investments, this is from the oil and gas majors, falls way short of what they need to be doing in terms of the capex required to be in line with a low carbon transition. So it's not enough to say, well, we need to finance these organizations. We need a scrutiny process to ensure that there's real credibility. And finally, as a strategist, the biggest risk to strategy or intentional strategy is what happens when you don't look broadly enough and then other things just emerge, whether it's a pandemic or another crisis or conflict. If you don't look broadly enough, then your emergent strategy overtakes your intentional strategy. So what's imperative is that there is a holistic transition planning process which looks broader than just the climate aspects. It looks at how is it going to be nature positive? How is it going to underpin a socially just transition? Sean mentioned earlier about the flood risks maybe from the Danube. Well, beyond just the narrow just transition focus of displaced workers from the coal industry, how is it going to affect all aspects of social justice and equity? How many people will be able to qualify for a mortgage when there's high physical risk scenarios and floods are rife? These are the kind of areas of strategy which are going to be most needed by investors to scrutinize what is salient for the future, and in particular for regulators to be able to look at when marking the homework when these plans are published in the very near future. That is all that I wanted to say today. I look forward to the discussion in the panel, which will follow. And thank you again for letting me contribute today.
Mr. Vaccaro, thank you very much. Please welcome to the stage the participants of the first panel discussion, Mr. Mark Campanale, founder and executive chairman of the Carbon Tracker Initiative, Mr. Robert Sproit, head of the Sustainable Finance at ING, Ms. Beata Parocai, associate at the European Bank for Reconstruction and Development. Moderating the first panel is Mr. Gábor Gyura, consultant and the United Nations Environment Programme's Finance Initiative. Mr. Gyura, the floor is yours.
Good afternoon, everybody. I think we will have a great pleasure after a great panel, hopefully after a great presentation from James. I think thanks for spotting the other microphone. It's a little bit strange noises, but I mean, now I just understand the source. Thank you. Great. Okay. So I wanted to say that I think we have a very interesting panel with a think tank, Carbon Tracker, with I would say, a very, very inspiring but also provocative message for capital markets. We also have in this panel the EBRD, of course, who played a huge role in the transition of Hungary and Eastern Europe to a market economy, and now is should play a huge role in the transition to the climate transition. And of course, also online we have with us Robert from ING, a global bank. I think really a forerunner or pioneer of sustainability. I think there is always a lot of attention about what ING is doing. Also, NGOs are very closely following the activities of ING, so I'm sure we'll have a lot of interesting thoughts from you. But before we start, let's maybe, as a warm-up, have a quick round. So does any of you have any quick reactions to the presentation of James?
I have a quick reaction. I find it now very hard to say everything that I have to say because James has covered a lot of things, so I will feel like a bit of an echo here, but I will say them anyway.
Yeah, maybe also a comment from my side, and then I was also interestingly listening to what James was mentioning, and also what came to mind is zooming out a little bit. So we talk about financial risk, so the two lenses, what he showed, and environmental risk. But what we shouldn't forget is that we built an economic system based on resource depletion. So natural resources, and also in a competitive environment where we also do not shy away to go to low labor cost countries. And this is the way we shaped our economic system. So an economic shift has to take place. And there are many, you can go all directions, but I just pick one is for now, is for example, on what is the consumer willing to pay? So if you want to have a system change, you need to change the value chain. And parties in the value chain need to decarbonize. And who is going to pay the cost? Is that then purely going through the party who is going to has to decarbonize? Is it throughout the value chain, or is it consumer who has to pay? And this is something we are confronted with a lot. We see it, for example, also in when we talk with the consumers, for example, for plastics. They are confronted with the fact that they want to go for example, bioplastics or recycled plastic, recycled content. But compared to virgin material, it's so much more expensive because of gas and naphtha is coming out of the ground for almost zero, and then you have only your netback price, so your production price and your transshipment price to wherever you want to take it. And then the question arises, okay, if you cannot pass it on to your consumers, how can you make this happen? And then you saw in the EU, you saw that there's an obligation from 2025 onwards that 25% of your PET, at least, or your plastic bottles, have to contain, so 25% of recycled content. And now clients are calling us and asking, okay, can we seek financing for new recycling facilities? So you need to have a kind of catalyst in that system, also to have a trigger effect, to have a systematic change in parts of the economy. So it's a little bit of a long answer, but this is something we really see as an issue in the transition.
Yeah, just add some comments. Those that don't know Carbon Tracker, we're a non-profit financial think tank. There's about 50 of us across the Tracker group. We model the energy transition risk. So just starting off on the first comments, the link between financial stability and climate change. What are the primary responsibilities of central banks around financial stability, and what have we heard? The way I've heard the conversations is 150, 200 years we've built a global industrial and manufacturing base that's based on fossil fuels, and yet over 10 years we're going to have to dismantle that system and the financial system that sits on top of that. We're going to have to dismantle that and rebuild something very, very quickly. And so it tells me that transition risks is perhaps one of the most important risks we should be thinking about today. But what are the questions that are crucial to central banks and stability that we're not thinking about? And this is what I ask central bankers around the world, and I'll ask it today. What is the total outstanding loan book of the banking system to coal, oil and gas, to the fossil fuel system? Do we know the answer to that question? No central bank is looking at that question. Nobody has the macro numbers that tell us what the outstanding loan books are. Just to put that into context, in the last 10 years, there's been 2,500 coal, oil and gas IPOs on the world's markets. No regulator is looking at the consequences of unraveling that kind of equity raise and the bond issuance that sits on top of that. So that's about 650 billion of equity, and on top of that, there's around 2 trillion of debt that sits on top of that. We're actually making the capital markets more carbon intensive, not less. So when Carbon Tracker, we did our first stranded asset carbon bubble report 10 years ago, we found that there's 700 gigatons of CO2 owned by listed fossil fuel companies. And we know the carbon budget means we must keep to below 300 gigatons. Okay, so 3 times more fossil fuels are owned by publicly traded companies than we can burn. And yet every year we allow more coal, oil and gas IPOs. There was a coal IPO during the COP. It was a London-based IPO. It was 6 times oversubscribed. It happened during the COP in Glasgow. There's a disconnection between financial regulation and regulatory oversight of capital markets, which no one is addressing. So we did the study 10 years on. It's gone from 700 gigatons to 1,000 gigatons. So the carbon intensity of the world's capital markets has gone up by 40% in the last 10 years. So my point being, are we looking at the right indicators? So that's, and then my second point, very quickly, is how much of the world's bond markets is linked to the fossil fuel system, to shipping, cement, steel, aviation? Now, in our report, The Size and Decline of the Fossil Fuel System, you can download it off carbontracker.org, half of the world's corporate bonds, non-bank corporate bonds, are linked to the fossil fuel system. Shipping, aviation, cement, steel, oil and gas. Half. We're going to have to unravel that and change that fundamentally within a decade or so. And about 25% of the world's equity markets are linked to the fossil fuel system. So when I like to think about regulation and stability, please can we get the right data? Please can we think about the right problems in the right way? Can we get exchange regulators working with central banks, thinking about how capital markets are working successfully together? Those fossil fuel IPOs are making the world's pension funds more carbon intense, not less. We give them targets to decarbonize, and yet because of benchmarking risk, they have to buy every fossil fuel IPO, okay? So it's a bit like running up a downward escalator. We're asking the banking system to be less carbon intense at the same time as making it more carbon intense. This is a contradiction which we must address. And this morning, I hope we can come back to that conversation that we heard this morning.
Sure, and I want to get back to already several elements that you and also Robert and Beata, you mentioned. I just maybe want to get back to you first, Mark, with a follow-up question. You already expressed some encouragement for regulators to do more. Also expressed some, of course, that we need to work on the data challenge. But I also want to ask from you the fact that basically this carbon bubble has just grown in the recent 10 years, and you mentioned this example of this IPO of a fossil fuel company just when the COP took place. Can we also say, maybe it's a strong statement, that markets don't really consider credible the Paris climate agreement, that they don't believe that this will be really the pathway that we are going on?
I was in New York for Climate Week, and I'm on the advisory board of GFANZ, and I get to talk to GFANZ members, and there was a very senior one, and he pointed his finger at me and said, the trouble with you, Mark, is you want us banks to behave as if you want the world to be, not as the world is. We will invest according to how we see the world, and if the world's going to 2.7, which is where we're going, we'll invest on that basis. And I said, whose money are you using to make these decisions? He said, well, of course, we're using our clients' money. So I said, what do your clients want? And he said, well, our clients want 1.5. And I said, there is your problem. The investment banks and the fund managers are acting as if they see the world, not as if what their clients want. If they were investing according to what their clients, many of whom are members of GFANZ or the Net Zero Asset Owners Alliance, they wouldn't be investing in that way. But you then have an analytical problem. Here is the stress tests. Here is the stress test that we should be doing. 2 stress tests. What is the value of the equities of companies you own in your pension funds if we cut emissions by 50% over the next decade? Now, let's give you an example. 50% of global shipping is shipping liquid fuels or shipping coal. Now, what happens to the world's shipping, the listed shipping companies, when you cut demand for their ships by 50%? Because, of course, you won't be needing to ship gas, you won't be needing to ship coal or oil. Do the valuations go up or do they go down? It's a simple stress test. This is and the same for oil and gas. If we have to cut demand
very interesting angle, and also like the viewpoint of investors, be them also like retail investors, and of course we could also like a little bit think about how aware investors in pension funds, I mean retail investors, about what kind of investments their pension funds are doing on their behalf. But I would like now turn to our banker panelists. We've already like gone into the world of climate risks. So maybe let's start with Robert. Recently, ING signed up for the Net Zero Banking Alliance, and I'm sure that maybe some people in the audience have heard about the Net Zero Banking Alliance, but I would assume that the majority of our audience today haven't heard about the Net Zero Banking Alliance. So can you just a little bit explain to us what the Net Zero Banking Alliance is, and basically what is the commitment ING has made?
Yeah, thanks. And thanks for the question. Also, a remark to Mark. And it feels a little bit that he's putting banks in that respect on the spotlight. But I agree that pension funds and banks are there to service their clients. So that is also how we, as ING, look at it. So we work for our deposit holders and our shareholders. That is our end client, and therefore we are putting sustainability in the heart of everything what you do, that is also in the core of our strategy. And because we need to manage physical and transition risk on our balance sheet, but also support our clients through the transition. So we are financing the real economy, that we don't step away, but we want to support the economy to transition. And that ties in also with your question on the Net Zero Banking Alliance, which is pretty much the benchmark for the market, for the banking market, how to decarbonize the lending portfolio. And before I go into details, we started with this already earlier. So we joined the NZBA, but we were working on this already since 2018. So we launched an initiative called Terra in 2018, where we aligned our lending book to the Paris Agreement. And we didn't do that alone. We did it with a think tank, an NGO called 2DI. We set science-based targets for these sectors, specific pathways, and that is the 9 highest emitting sectors in our portfolio, and we plot our clients against it. And if a client really derails from this pathway, then we also make an assessment how to go about it. So we engage with the client, or we have a discussion around capital allocation. So it is quite serious. We have been quite vocal on this. So in Katowice, we attracted 5 more banks to join this initiative. And then later in 2019 in New York, it was 30 banks joining the initiative. And later on, the NZBA came to life. And that is really good because of it's really a common ground for banks to how to decarbonize. So on your question, what do banks need to do? So they have to commit that their lending and investment portfolio is aligned with the net zero in 2050 or earlier. Within the first 18 months of joining, the bank has to set also intermediate targets, so 2030 targets and 2050 targets. But also after 2030, every 5 years, they have to set a subsequent target. And then within 36 months, they have to create a pathway for the highest emitting sectors in the portfolio, which we already did. And they have to report progress against it. And we do that through our integrated climate report. So our Terra report, we published already in 2018, the first one, and then we publish it every year. And we use always science-based targets to set the targets, and we use the greenhouse gas protocol for our carbon accounting. For sectors who don't have a specific pathway, we are in specific, we could team up with the financial market, with NGOs and think tanks. So, for example, we are in the founding group of the Poseidon Principles, so that is the decarbonization initiative for shipping, but also are leading the Sustainable Steel Principle Working Group, so that's from UNIPEVI. And sorry, this one is from the Rocky Mountain Institute. That is another one. And that is what we want to do, is to create transparency also in the market on the decarbonization trajectory of steel. And what yesterday was published, and that is with UNIPEVI, is the guidance, the transition finance guide under the NZBA. And that is because of banks have committed to it, but they don't exactly know how to transition. So in that guide, it's stipulated where that the targets, for example, need to have a certain ambition level, that the KPIs is set in their business are also net zero aligned. They have to disclose on this, and they have to have a governance structure in place, and also accountability, which is important that, for example, your CEO is endorsing this. And then also on the financing, it's focusing on the one side on use proceeds financing, which is financing to specific activities. So, for example, green financing. And then it's guided towards the taxonomies, what was stipulated by Shana. And taxonomy is the handbook of what is a sustainable activity or a green activity. And or the bank needs to have their own transition finance framework in place. And then you have general corporate purpose facilities, where there's a transition plan So that is the general corporate purpose facilities is if banks are providing financing on that basis, that they connect ESG KPIs to that financing and with specific targets, which should be ambitious and material to the business model. And then on that basis, the price, if they meet it, it will go down. If they don't meet it, the price will go up. And to be able to ensure that it is ambitious, this transition guide is also saying you need to have a transition plan in place. So not only just cherry pick on KPIs, but have a proper plan in place. So that is a little bit of a snapshot of the NZBA.
I just want to get back to you with a short follow-up question.
Yeah.
I just want to more understand your motivations to sign up for the Net Zero Banking Alliance. In Hungary and also in Eastern Europe, only some subsidiaries of Western European banks are like part of this kind of commitment. So I think up until today, banks like having their head offices in Eastern Europe, I think they haven't really signed up to the Net Zero Banking Alliance. So the question is, why did you do that? Is it like pressures from your investors, from clients, regulation, or what is basically your motivation that you made such a huge commitment? Because it's really a huge commitment to make your balance sheet net zero.
No, I believe because we have to, not from the investor, but just for what I already mentioned, for our deposit holders, our bond investors, and our shareholders, and so our clientele as well. It is managing risk on the one side on a balance sheet to ensure that transition risk. So if you, for example, it can become a chair answer, and that is also an analysis made with Mark from Carbon Tracker in 2015. I believe we already did it. We looked at stranded asset risk. So what will be the risk to end up with stranded assets? And that is obviously not a story you can explain towards your investors / your bond investors, your equity investors, and your depositors. So you have to manage that properly. And yeah, the NZBA was just a little bit of a confirmation that we were going into the right direction because of Terra. We already launched 4 years back. And last year we signed committed to the NZBA, which is just a small alternation of something we were already doing. So it's really an intrinsic motivation to do this. I also understand, for example, Hungarian banks not yet joining is because it's rather complex, huh? And I would like to invite them to look at our integrated climate report because we are very transparent in our methodology how we do it, and I'm happy also to talk with Hungarian banks to explain how the methodology has been built up, and that can also be used by other banks. And the guidance documents provided by the NZBA is also helpful to build such a transition plan for your lending book, and that's part of the complexity. We have to take that away. Next to that, you see that the NZBA, that the US banks are retreating slightly, and that has to do with the SEC also putting research in place on those American banks. If they have a commitment in place, how they are going to follow this. So we have to be careful as regulators that we don't overregulate it. We at least have to bring everyone on board, go in the same direction, and then use regulation to facilitate and to support it, instead of just carrying banks away. But I have to admit, there's quite some steps to take to bring everyone on board and make everyone comfortable with such a commitment.
Thanks, Robert. And also, I think the kind offer to share your experience with Hungarian banks if they are interested in becoming net zero. So I want to turn to Beata now, coming from the EBRD, which is, of course, a very special bank with a very special geographical scope. So what's your take on the Paris Climate Agreement? What is your climate strategy?
Yes, so here I would like to outline the climate ambition of the EBRD, but maybe before we go into there, let me a little bit introduce myself. Thank you for the invitation. It's a pleasure to be here and an honor. My name is Beata Poroxai. I work for the EBRD in the Green Financial Systems Group within the Climate Strategy and Delivery Department. So I joined the bank in 2011, and ever since then I've been working in the green finance space. So what my team does is we're working very closely together with banker colleagues in financial institutions department to deliver the EBRD's climate and green agenda, basically, from throughout the investment operation, from origination, structuring to implementation and monitoring. And part of our job is to provide advice, of course, market and technical advice to banker colleagues, as well as carry out the green and Paris alignment assessment of our banks throughout the investments. So a little bit about myself, I wanted to say. And so outlining the climate agenda, climate ambition of the EBRD. So I think many of you probably know that the green transition has been very much in the core focus of the bank for quite some time now. We have our green strategy called the Green Economy Transition, or GET approach. This was approved or updated most recently in 2020, by which the EBRD is actually aiming to accelerate financing for projects that advance the transition into low-carbon, climate-resilient and environmentally friendly economies, while also preventing economies from being locked into polluting and environmentally damaging pathways. So essentially, the EBRD has made a commitment to become a majority green bank by 2025, so very soon. This will mean that at least half of the annual business volume will go for projects that support climate change mitigation, adaptation, and other environmental measures. Of course, our green strategy also sets out that EBRD will align itself with international climate agreements, which means Paris Agreement, basically. And for that, we're also going to enhance our policy engagement to develop low-carbon, long-term strategies, as well as, in the climate space to provide any policy advice and support. This is about the climate ambition of the EBRD.
Yeah, thanks. I would like to follow that also on, and would really be curious, and I think also the audience will really be curious about what you are really doing in the region in terms of actions in Eastern Europe, especially about energy and energy efficiency. And maybe that should be the second topic for today's panel. And again, I would like to turn to you, Mark. We see a lot of course, discussions, especially now in light of the ongoing war, about energy security, energy affordability, but of course, still to the need to decarbonize the energy supply. And of course, there is a lot of discussion about further investments needed into LNG terminals, new pipelines, coal-based power plants are reopened because of the turbulence in energy markets. Also, the prices, of course, it's skyrocketing. Maybe they attract, again, new investments into less clean energy production technologies. So how do you assess this very, very turbulent situation? And are we moving away from decarbonizing our energy supply?
So let's have a look at some of the numbers. So energy demand globally is growing about 1%. If you look at installed capacity for wind and solar, that's growing about 20% per annum. So there's we heard earlier from Sean Kidney that this is an irreversible trend. And the reason why it's irreversible is purely one based on economics, on costs. So Everyone remembers when you first bought a mobile phone or a color TV, it was very expensive. The more you manufactured, the cheaper it got. Exactly the same thing is happening with wind and solar technologies and hydrogen. The more we build, the cheaper it gets. And what we've got is a battle between molecules and electrons. And molecules, where you're dependent on, say, coal, oil, and gas, you've got to move it from one side of the world to the other to use it. Now, if you're talking about Canadian oil sands, you've got to mine this stuff, you've got to boil it up, you've got to put it in a pipeline. You then have, if it's a gas, you have to compress it, put it to the other side of the world, decompress it, put it in a tanker, take it to a power station, then you're going to try and burn it, and then afterwards you're told to get the CO2 out. Now, this stuff that you're doing is inherently inflationary. It just costs a lot to carry on doing what you're doing. All the cheap stuff is gone. Now look at the opposite with electrons. You're manufacturing your energy at your point of use, typically. You can scale it like a technology, and what we know from technology and innovation, the doubling of production, you get a 20% reduction in costs. It's a battle between an inherently inflationary system, the fossil fuel system, and an inherently deflationary system, which is technology. So just right now in the United Kingdom, in the latest auctions, the lowest bids came in for wind and solar at £38 sterling a megawatt hour. Gas coming in at £300 a megawatt hour. The problem that we've got in the design of energy services and delivery to domestic consumers is the consumer doesn't pay the lowest cost for energy, they pay for the highest cost of energy, the marginal cost, which is why everyone is screaming that their bill's gone through the roof. So how is it possible that the UK, we had 60% of our energy needs were met by wind and solar during the summer? How is it during that same period our bills went through the roof? It was because of a very badly designed pricing package for energy. So to answer your question, to resolve the problem that we're facing today, is the answer to an energy and gas crisis to build more gas? The answer is to build less gas and to build more renewables, and that's what we're seeing. So today, we've got about 2 terawatt hours of wind and solar built, growing at 20% per annum. So within, if we can do the maths, within 6-7 years, there's going to be 8 terawatt hours of wind and solar by 2030. And that is probably going to be the same as all the world's gas and coal capacity. Capacity is not the same as power generation, but the point being that we're building this system very, very quickly. Problem with gas is to bring it online, to find it, develop it, bring it online, you're talking about 6 or 7 years. During that period of 6 or 7 years, you'll see massive demand destruction for LNG and for gas. And if you look about what gets onto the grid first, the cheapest energy typically gets onto the grid. So in Germany, you've got super efficient gas-fired power stations, turbines, that have never come on stream because they're always more expensive than the cheapest renewables. And so they become redundant, stranded assets. This is a risk warning to people thinking to build more gas. And the geopolitics, that's my final point. 80% of the world's population live in energy importing countries. 20% live in energy exporting countries. So Russia, well, when it was exporting, the US, the Middle East, and other bits and pieces like Venezuela coming into the market, these are not great nations when you think about it. Even the American political system, which is tied to the fossil fuel system. Getting off of fossil fuels will create not just a financial dividend, it will create a political dividend. We will no longer be subsidizing the very few economies that control our energy markets. Getting off of dependency on relatively few economies like Russia, like the US, like Canada, will actually liberate economies with energy independence, with cheaper energy. So that's my prediction for the future. I think it's a happy prediction for the future. Cheap energy, an energy system that's stable, we get rid of dependence on oligarchs, and it's an irreversible technology trend.
Thanks also, like, I think, bringing hope into the discussion. Sure, and I want to turn to Beata now. Of course, EBRD is a very important player working together with financial intermediaries and also, as a bank, also sometimes financing project itself. And you've already mentioned your green strategy, green transition strategy, what?
green economy transition.
Yeah, thanks, and also like your commitment in relation to the Paris Agreement, and of course, as we've already like touched it upon, energy is a key part of that transition. So can you just a little bit like talk about the EBRD's activities about renewable energy, maybe especially energy efficiency, which is probably one of the key and best methods to, again, address the current challenges?
Yeah, definitely. So the EBRD has implemented several successful energy efficiency programs in the Central and Eastern European region. Just to give you an example, in Slovakia, for example, we channeled 270 million euros through 5 partner banks for investments, for financing basically private companies, housing associations, and energy service companies who wanted to implement residential and industrial energy efficiency investments. These are building energy improvements, for example, in the residential space, but it can also be process equipment replacement in a machinery replacement, for example, in a factory, and so on. And also small-scale renewable energy, and these were mainly solars and also windmill investments. So almost 700 of these green investments were implemented throughout long years. I mean, this program has already closed. The latest phase just finished. The 3rd phase of it just finished. And this was a green economy financing facility by which EBRD channeled these funds through financial intermediaries in the country on lending to the real economy, basically. And for this, we used technical assistance, and this was donor-funded technical assistance, consultants, basically, who helped our banks and also the clients to make the right choices and actually develop their green investment, energy efficiency, or renewable energy investments according to the best possible option, really. Some form of grants were also provided. But in the residential space, almost 100,000 people benefited from building improvements. So I think this was a great result that was achieved there. And the other one is Poland, where we focused on small and medium-sized enterprises, given the significance of SMEs in the Polish economy. And these were small businesses, for example, wanting to improve the competitiveness of their business, reducing their bills, energy bills, and continue to benefit from efficient use of energy in the future. I mean, once they, for example, they replace their equipment, their vehicles. These are agricultural vehicles as well, for example. And there we also work with leasing companies, not just banks, but also with leasing companies. And almost 8,000 of small, tiny projects were implemented throughout the country. And of course, these add up in terms of carbon reduction and energy saving. So these are the credit line facilities. We've been, the EBRD has been financing these programs. It's an umbrella of programs for a long time now. But capital markets as well. Green bonds. So basically, the EBRD is committed to the sustainable development of capital markets in this region, most specifically green bonds. I believe last June, we have passed the €1 billion mark in terms of green bond purchases across at least 30 operations. Most of them were in EU countries, of course. But what is important to note here is that the capital market is developed in a concise, consistent, and transparent manner. So EBRD has to kind of ensure that we have our green criteria, of course. And EBRD has to ensure that all the investments are complying with its green criteria, which in the EU context is aligned with the EU taxonomy, of course. So it will be important for any future green bond frameworks to bear this in mind or consider this in the future.
Thanks, and also it was really nice to hear about this comprehensive approach. You mentioned technical assistance, for instance, also like helping these countries to develop their capital markets, so that I understand you are targeting some kind of more of a systemic change, so not just like one-off transactions, but like creating the foundations for a more long-term and more fundamental changes in these economies. A similar question to Robert. Of course, ING is a truly global bank, but you also have some operations in Central and Eastern Europe, if I'm not mistaken. Maybe Poland and probably Romania they are your major markets. Also, of course, your presence in Hungary has a bit changed throughout the years. So can you just a little bit also like mention some examples in your sustainable finance activities, especially in the region? And also if you can also mention some links about, again, energy, clean energy supply, also energy efficiency, some examples of what can you do as a bank in these fields?
Yeah, so a little bit of a dual track on the first side, just on the CE countries, so what are we doing? And secondly, on the energy side. So if you look at pure sustainable finance in the region, it's relatively new, but I'm saying relative because sustainable finance market is new in itself. Since in 2008, the first green bond was issued by the World Bank and EIB. Took 8 years before the first 100 billion was being issued. So it went very slow. And then it has a huge hockey stick. So last year, according to Bloomberg, it was 1.6 trillion what was issued in the market on the sustainable finance side. And it's expected by the IEA that the market will grow to 5 trillion by 2030 annual volume. So you see a huge uptick. Now, if you look at our portfolio, in 2017 we put sustainability-linked loan product in the market. Before that, we were focusing on green financing, despite of the fact there was not really a taxonomy. And then we really grew the book. So we did 58 transactions in 2018, 2019, 2020, both around 130 transactions. And then last year alone, 317 transactions. This shows also how this evolves over time. And in the first half year of this year, despite of the fact that the bond market is really slowing down, given the fact that interest rates are hiking and there's unrest obviously in the market, we see that we closed 205 transactions on the sustainable finance side. In Hungary, we did in 2020, we were very honored that we were acting as book runner for the 1.5 billion first green bond for Hungary itself. And the bond proceeds, the proceeds of the bonds were used for the climate change and environmental commitments of Hungary. This year we supported OTP Bank with their debut green issuance. And an interesting one to mention, I think as well, if we go back to energy, is PKN Orlen. So if you look at oil and gas companies, sometimes have challenges to attract funding from the sustainable finance market. So they attract funding normally through normal capital markets. They attract funding specifically for non-recourse project financing, for example, or recourse for project financing of their renewable plans. But really getting into the sustainable finance market is sometimes challenging. And for PKN, we did a green bond, so financing the pool of green assets on the portfolio, so the renewable assets, for example. But next to that, what we did is that we connected the financing or embedded into the financing the climate transition handbook. And that climate transition handbook is from the ICMA, so that is the overarching guiding governance structure of the sustainable bond market. And what the handbook is saying is that a company needs to have a strategy in place for decarbonization. It has to fit with the business model, the material point of the business model. It needs to address the risk associated with climate risk on their company, but also the climate risk they have on the environment. So the risk they have on the environment, and they need to disclose and have a governance structure around it. And that is quite new. That was to the bond market, to be honest, because green bonds were issued just really after each other, and you see now the market turning, where, for example, I'm also in the ESG committee of the LMA, where we also discussing to embed the transition handbook into sustainability linked financing, so that clients can set KPIs and targets, but they need to adhere to this handbook. And also on that NZBA guidance document, which was just issued, where we were part of, also it's alluded to towards this climate transition principles. And that is something the market will turn more towards. Now, looking at energy, and I think for the sake of the audience also, of many Hungarian banks in the audience, let me tell a little bit what we are doing on the energy transition side. So we started with assessing energy transition scenarios in 2017, and we did it together with Bloomberg New Energy Finance, and also with Carbon Tracker. We, for example, looked at stranded asset, what I discussed earlier. But with Bloomberg New Energy Finance, what we did is to assess scenarios and what the risk would be on our portfolio. And like Mark was mentioning on the $18 per barrel, those kind of scenarios, that is indeed what we sometimes see in the market, but we have been more stricter ourselves. So we had 4 scenarios. One is merely the growth model, which is based on economic growth. Then the scenario where we see technological developments, rapid technological developments. The third scenario is where we see fast government intervention. And the fourth scenario is the fast forward scenario, where we combine the technology and the government intervention. And that fast forward scenario is determining our risk appetite in the market. Further on, what we did is that on the Terra, we committed also to reduce our upstream activities. So on the one side, we want to reduce our upstream financing to 90% by 90% in 2030, and then net zero by 2050. But more importantly, if you look at the IEA report, no new upstream exploration is required to meet the net zero goals. And so we committed also to do no new exploration financing anymore. So that was quite a step, and a lot of NGOs came to us to get a proper understanding of what we were doing, and also wanted to incentivize other parties to do the same. So we see quite a movement there, which will come to the market, I think, quite soon. We increase our renewable financing by 50% by 2025, so from now on, so a growth by 50%. And we focus as well, as alluded to by Mark as well, on new technologies. So we have specialists on CCS, so carbon capture and storage, specialists on hydrogen, batteries, and we have a team focused on new technologies which are still have to come to the market or are not, let's say, mainstream yet. So specific energy transition of energy efficiency projects, bioplastics, recycling, water, and waste productions. Now, then on the oil and gas market, to attract sustainable finance, as mentioned before, it's difficult for them sometimes to attract financing to the sustainable finance market. We believe as funders of the real economy that we need to engage with clients. So seek always the engagement through our financing to set targets together with the company which are science-based and have a clear pathway to net zero. And not just shy away, because we believe as well, if we would just sell off our exposure, and sometimes NGOs are asking for that, is that it will be bought by parties who have less stricter regime around the ESG parameters of companies. So we better stick to it as original financiers and engage with them and be strict with them if they wouldn't meet specific pathways. So that would be, in a nutshell, would be our approach to energy transition, let's put it that way.
Do you want to react on that?
Yeah, thanks, Robert, for that mention about our cooperation. This is my second time in Budapest. I started in green fund management in 1989, and in 1992 I came here for the first green finance conference in Budapest in 1992, so 30 years ago. And 30 years on, the world's made huge progress, and I salute the leadership of the Hungarian Central Bank and bankers here. Listening to Robert speaking, he made a very important statement that ING is not going to fund oil and gas exploration or expansion. I think this is really important to note. When we go back to look at capital markets more generally, of course, the capital markets are completely open to fund, through the bond markets, fossil fuel expansion. And there's some profound contradictions. I read the Saudi Aramco bond prospectus. I don't know how many people read that. It was a pretty big bond issuance. It's one of the biggest in the world at the time. And in it, the prospectus said, we completely support the goals of the Paris Agreement. We're completely committed with dealing with climate change, but by the way, here's 30 pages of projects we're going to be developing over the next couple of decades. That was what the prospectus said. So to extend what ING is doing from a single bank to the markets as a whole, and if we acknowledge the fact that we've already funded more fossil fuels than we can possibly burn, we need regulators, we need a moratorium on new fossil fuel bond issuance for expansion. Just like ING, it shouldn't just be ING, it should be every bank and every regulator should be calling a moratorium on fossil fuel bond issuance so that we're cutting back on... But the analogy I want to give is it's a bit like announcing to the world that you've gone on a diet, a climate change diet, and you're going to stick to eating salad, but going back to your office and gorging on a box of donuts. You can't say you're on a climate change diet if you continue to fund the expansion of the fossil fuel system. This is a fundamental contradiction which can't be dealt by governments alone, and it can't be dealt by individual exchanges or even indeed individual banks. It has to be dealt with through IOSCO, through the World Federation of Exchanges, through the Basel process, and through the role of central banks. That was my kind of main comment on this, is that if we have a systemic issue, which we have to deal with it systemically, and that involves leadership. And I couldn't help but write down the remarks of the Deputy Governor that opened today that said we must not waver from funding of fossil fuels. We need all the banks together, and he called out some of the wobbling by the American banks that are inside GFANs. We've got to get the banking system aligned with climate goals, and that really has to mean cutting back funding of fossil fuel expansion. It doesn't mean you stop funding them completely, it just means you don't allow them to build any new exploration projects.
Yeah, absolutely. I totally agree. The EBRD has fossil fuels exclusions, and I didn't mention this earlier, but basically in 2021, the decision was made to align all the bank's operations, all, not just green, all of its operations with the goals of the Paris Agreement. And so ever since the announcement, of course, the EBRD has put a lot of effort into developing the approach and the methodology in how to implement this. I mean, nobody knows, right? I mean, it's a new thing. So EBRD is still at the forefront, but that doesn't mean that the guiding principles are just, you know, we just came up with it. No, it's firmly guided by the Joint Multilateral Development Bank, or MDB, principles. There are 6 building blocks. I'm not going to go into details about them, but the point here is that all of the MDBs, they agree that these principles should be followed in terms of Paris alignment implementation. And so we now do have an approach, operational approach, and it's also mirroring the TCFD, which was mentioned earlier. And so one of the route, and I'm sorry if I'm going too much into detail about this, but this is a topic that is very close to my heart, and this is something new, because imagine, I mean, we want to accelerate the Paris alignment of the financial sector. And why do we want to do this? Because if we are limited to EBRD use of proceeds, so for example, we extend the loan for on lending, the impact that we generate, energy saving and emission reduction, will be limited to those funding. But if we can work with the financial sector and ensure that they themselves align their own financial flows with the goals of the Paris Agreement, then the leverage is much better and the impact is much better. So this is very important. The systemic change, as you mentioned, and also the role of the financial sector in this.
Thank you very much. And since the title of this panel was like transition plans for banks, so I mean, it's also like very good connection there. So unfortunately, our time is almost up. Maybe I would just like to have one very final short question to Robert. Also like to follow up on Beata's point about the role of commercial banks. And also, since this conference is organized by the central bank, by a regulator, and of course many commercial banks are here in the audience, and since this is like a conference that I mentioned, organized by the regulator, just one final question about regulation, sustainable finance regulation. A lot has already come from the EU, also some local regulations coming in Hungary. EU taxonomy, for instance, one very important and huge policy development, and of course now many banks are fully working on what the EU taxonomy means for banks. So what are your thoughts, Robert, about the EU sustainable finance agenda? Is regulation already mature enough? Are there any other elements missing from the regulatory landscape? How much regulation is helping in your sustainable finance journey? That will be my final question, in short.
It's a short question, long answer. I will keep it short as well. Regulation is key. Yeah? I started off with the reaction on James that sometimes it's a value chain issue where the consumer doesn't want to pay for a kind of a product. And if you want to change the industry and the production process, you need to have regulation in place. For example, 25% mandatory blending of recycled plastic in plastic bottles. I think a few important elements in regulation is to get clarity and consistency, and also important is that you get a common ground. So not that regulation is being built fully in isolation, maybe to stimulate specific pockets, yes, but you need to find common ground. And it was also mentioned by Sean before, you have, for example, the carbon border adjustment mechanism. So that is in the EU, is that you get a tax levy if you start producing outside of the EU and start importing on a non-sustainable way. So that creates already common ground. Now that is one, to create common ground. So also common taxonomies across the globe so that you know exactly what is a sustainable activity, and not that it's on the one side of the globe it's sustainable activity and on the other side it's not. Then the availability of data. If you come more often to these type of discussions, then a lot of people are saying data is the most important one. Also for banks, for example, I have to report on the green asset ratio, which is the ratio between your green asset portfolio versus your total portfolio. You only know what your green assets are if you have the data available. And the same accounts, for example, for risk. So if you want to understand your risk with your clients in transition pathway, you need to have that data available. So the Corporate Sustainability Reporting Directive is a new kind of regulation which will apply in the EU. And the interesting thing is that it falls on a non-financial reporting directive, and that is an obligation for if you have more than 500 employees in your company, but it is already stepping down to 250 employees, but also making a next step towards the SME. So it's more encompassing, broad in that sense, in terms of reporting requirements. And there you need to disclose how your business model and strategy are aligned with the transition requirements of your sector. You have to report on your material ESG topics, the impact, risk, and the opportunities. And you have to have an action plan in place. Now, that is already very helpful. Then other regulation, then SFDR, I don't want to go into detail on that, but this is an important one for corporates because it shows them also, that allows them to also think about what the transition should be and where the risks are, but also for financial institutions to manage that risk if they have the data available. One which is in the pen at the moment in the European Parliament, and it has to still be approved by the committee, is the sustainability, the corporate sustainability due diligence. And in that, what the interesting thing there is, so first you need to identify the environmental and social, the environmental and the human rights impact you have, but not for yourself, but also your business partners. So if you're a corporate, you have to address the impact of your value chain as well, and then not just can ignore. So that is addressing partly the value chain issue, but for banks, it's also your clients. And if you identify such impacts, you need to take preventive actions. And there it comes, what is an important one to look at, is that if you don't take preventive actions or not sufficient, the member states are allowed to impose penalties or even civil liabilities. So that is a huge one. If that really comes to the market that way, that could mean that you can have civil liabilities against your board, for example, of your company or to your bank, if you don't take preventive actions. And then coming back on your point on, for example, Net Zero Banking Alliance, also for Hungarian banks, it's important to get into these alliances to show also to the regulators that you take preventive actions in this regard, and that you monitor it, get a proper understanding of it. Because, yeah, if you won't, you don't know exactly in a specific country what the direction of travel will be. And we see it in the investor market already happening. For example, DWS, there were litigations and research on greenwashing risk, also with BNY Mellon and Goldman Sachs. And you see that BlackRock is stripping the products already for sustainability labels because of litigation risk. So the sustainable finance market, in that sense, is really tightened, is being tightened by regulation, but also the consequences of regulation. So I'm very, very interested to see how that will evolve. So one is common ground, two is transparency, and three is, okay, we need to get our act together as banks, because otherwise we run litigation risk.
Thank you very much for walking through us all these myriads of regulations. And thanks for your participation, Robert, in the panel. And thanks also, Mark and Beata. I hope our panel today was interesting and inspiring for everybody. Thank you.
Thank you very much.
Ladies and gentlemen, we will take a short coffee break. It takes 15 minutes, so meet me at the coffee station. Ladies and gentlemen, now we would like to continue the conference with the second panel discussion, centered around the transformational power of green finance. The introduction will be given by Mr. Eig Scorecard, head of the United Nations Environment Programme's Finance Initiative.
Dear Governor Mikulski, distinguished guests, panelists, participants, my sincere thanks for the invitation to contribute to this important event. So, Central European countries, such as Hungary, have transitioned to market economies in the 1990s. And now, just as in the rest of the world, they are facing another huge challenge to become environmentally and socially sustainable economies. Finance is obviously key for that. So today, I'm going to provide an overview of the history of sustainable finance development, the trend towards strengthening a bank's purpose and alignment with society challenges like global climate change, and the current state of risk pricing regarding climate and other sustainability risks. Now, sustainability, ESG, climate change, human rights, the Sustainable Development Goals, it's a swirling range of issues bearing down on how a bank does its business. The 2022 Global Risk Report at Davos listed the top 8 most severe risks on a global scale as being environmental or social in nature. Now, the UN Secretary General Antonio Guterres has declared climate crisis as a code red for humanity. The forest fires, the floods, the drought, extreme heat, they're becoming the norm and are expected to accelerate. Look at what's just happened in Pakistan, in the Caribbean hurricane season, but also the extreme and historic droughts in Europe just a couple of weeks ago. Also, we have a raft of social issues which are moving quickly, eroding social cohesion, livelihood crises, increasing expectations around diversity, equity, and inclusion, and more. Links between environmental and social anomalies are becoming more and more obvious, demonstrated by, for instance, the sharply rising food prices driven by the recent droughts, and also in addition to the war in Ukraine. Do banks have the right governance, the right people, the right incentives, the policies, the capacities, the products and services to survive and thrive through the transitions that we are seeing underway? This is where both banks and banking regulators and supervisors really need to focus. This will help in thinking about the changing environmental and social context, the questions you should be asking. Now, responsible banking as a concept, I think, can be traced back to the 1990s when banks began to understand their increasing responsibility towards limiting financing for environmentally and later socially unsound economic activities. And from a transactional perspective, they began to implement systems aimed at doing no harm. In the 2000s, the legal basis for an investor to include environmental and social factors within their fiduciary duties and how they take investment decisions was firmly established. We at the UN established the term ESG, and we created the principles for responsible investment, which today is the global framework for responsible conduct amongst the institutional investor community. In the following years, I think 2 big significant developments led into this notion, including the global financial crisis, which really laid bare many of the inconsistencies across the industry, bringing into question the fundamental role, the purpose of the banking sector. On the Edelman Trust Barometer, the financial services industry dropped to becoming the least trusted industry around the world. Now, post-crisis reform did shore up bank balance sheets, albeit at the cost of decreasing long-term lending to the economy, but certainly it played its role in the shorter term. Meanwhile, banks did make progress in terms of environmental and social risks, integrating them at the transactional level. But their bigger role in society and in the economy remained, I would say, to some extent in a state of flux. Now, this leads me to the second major development, which is the signing in 2015 of 2 major UN agreements, including the UN Sustainable Development Goals and the Paris Climate Agreement. For the first time, the financial sector was visibly involved in these intergovernmental processes. The industry played an important reinforcing role when the Paris Agreement was signed, with many in the private sector, including financiers, supporting the agreement. It allowed governments to understand that it was in the economy's best interest to start putting a stop to climate change, to put a price on carbon, to invest in businesses and economies of tomorrow. Now, as part of the Paris Agreement, governments committed to do what's needed to align financial flows, both public and private, with the stabilizing climate objective. Since then, investments in renewable energies have boomed. Electric vehicles have really started to move. On the financing side, we saw the green bond markets grow from 1 to 2 to eventually 5% today of the fixed income market. Since Paris was signed, we've seen a lot of progress in scaling up green finance and low carbon solutions. But we also need to acknowledge that it's not nearly as enough as the parts per million in the atmosphere continues to rise. I think the problem is not so much the green activities being financed, but rather the rest of the loan book, the everything else that remains stuck in the old economy. So clearly we need a more holistic approach which goes really to the core of banks' business and positions sustainability considerations, not as a nice to have or an add-on to business as usual, but rather as a central tenet of our prosperity and growth going forward. Clear purpose and strategic alignment with society's goals is becoming a crucial determinant of a bank's competitiveness. Whether in its search for the most talented employees, its competition for customers, or its engagement with shareholders, sustainability is becoming increasingly material to corporate valuations and ever more decisive to a bank's comparative advantage. Now, this context set the stage for a growing constituency in the banking community, recognizing that reinstilling legitimacy and trust in banks increasingly depends on the industry clearly showing its purpose and value to society. Now, these considerations helped inspire leaders in the banking community to come together in 2018 to draft, under the auspices of the UN, a set of global UN principles for responsible banking. These principles were formally launched at UN headquarters by UN Secretary General Antonio Guterres and 132 founding signatory banks on September 22, 2019. The principles provide a framework for defining the notion of a responsible bank, a bank that not only manages the risks involved with the shift towards sustainable economies, but also plays an active role in channeling financing towards the new economic activities which need to be developed. Put simply, this is both greening finance and financing the green. With the principles for responsible banking, signatories are aiming to set a global benchmark for what it means to be a responsible bank and to provide a single framework that guides banks in clearly defining their purpose, their strategy to create value for society and shareholders, while enabling them to remain competitive, to seize the opportunities, and to thrive in a changing economy and society. Today, the PRB has 300 signatory banks, coming towards the 50% of global banking assets. A growing number of banks from Central Eastern Europe are also joining the community. We're very pleased to see the biggest Hungarian banks signing last year, and we hope that all the others are going to soon follow. So good progress, but much more needs to be done, since frankly, mainstreaming climate and other sustainability considerations into financial practice is still not moving fast enough, and nowhere is this clearer than in risk pricing. Now, the Global Association of Risk Professionals, GARPs, their fourth annual global survey of climate risk management at financial firms, which put out earlier this year, found that at the moment, most firms are not yet changing their pricing sufficiently. The European Central Bank, the ECB, in its 2021 assessment of the state of climate environmental risk management in the banking sector, also found that FIs are at an early stage with regards to integrating climate environmental risks into pricing approaches. And I think this reflects the complexity of pricing, in the face of, first, the uncertainty over climate policies, second, the challenges in obtaining data, and third, the immaturity of the methodologies. It's clear that pricing is an area where much more needs to be done. Sound pricing is built on sound risk management and governance processes. The ability to integrate climate environmental risks into pricing frameworks, is ultimately based on it's underpinned by sound climate risk assessment, management, and governance. This in practice means using stress testing and scenario analysis to both assess risks and strategies, and embedding climate risk considerations into business strategies and risk appetite limits, ensuring that pricing is consistent with, appropriately linked to these. It means consistently and comprehensively monitoring climate risk with enhanced and more granular monitoring for more highly exposed portfolios. It means using appropriate metrics, models, tools, data, and having an enhanced, more granular monitoring for more highly exposed areas. For example, heat maps and sectoral analysis are examples of useful, I think, evaluation tools into these. It means ensuring that approaches to establishing climate data needs, data accuracy, and overcoming data gaps are put in place and that climate risk considerations are built into due diligence processes. Now, and finally, it means integrating climate risks across the organization, ensuring the staff is adequately skilled and have the resources to undertake all of the above. It's all about a redefined sense of purpose at the highest levels for an understanding the risks from a changing climate, from nature loss, social strife, to pricing products and portfolios accordingly. Now, clearly, when war is ongoing in a neighboring country and when energy security is uncertain in Europe, it's difficult not to lose focus. But I think just to highlight the obvious, scaling up investments in renewables and energy efficiency is probably more important and more urgent than ever in the region. So despite all these huge challenges in the present, integrating sustainability considerations fully into financial practice is not a nice to have, but an absolute priority for responsible banking conduct in the 21st century. I wish you a successful panel and a session and progress going forward as we move into the age of responsible banking. Thank you very much.
Thank you, Mr. Asher. The second panel is moderated by Mr. Pál Péter Kolozsi, Director of MNB, responsible for the Monetary Policy Toolkit, Foreign Currency Reserve and Risk Management. The following panelists will join Mr. Kolozsi in the discussion: Mr. Luca Bertalot, Secretary General of the European Mortgage Federation, European Covered Bond Council, and Mr. Thibault Clisson, Climate Lead at BNP Paribas Asset Management, Mr. Andreas Reuter, Head of Sustainability, Ethics, Public Affairs at the Unica Insurance Group. Mr. Kolozsi, the floor is yours.
Thank you very much. Fortunately, we were a little bit more cautious with the microphones than the previous panel. I hope that was also very interesting, the panel. I have to emphasize and underline. So thank you very much for the invitation, and it's a great privilege for me to be here and honor to be here and to be the moderator of that fantastic panel with panelists representing the banking sector, the insurance sector, the asset management sector. I think that the financial sector is quite broad, but we are trying to have a quite large overview of the whole sector. One more time, we have with us Luca Bertalot, who is from the European Mortgage Federation, European Covered Bond Council, Andreas Reuter, Head of Sustainability, Ethics and Public Affairs at Unica, who is an insurance company, and also we have Thibault Clisson online with us from BNP Paribas, who is a climate lead of the bank at BNP Paribas. So the green issue is quite complicated. I think that that's common sense already, and that's why it is quite difficult to have a well-structured and well-focused and well-framed conversation about the topic. But we will try to do our best with the panelists. We can say at that hour that we are after a quite long day, but we can also say that we are after and we are in a quite interesting conference about green finances and the whole green financial universe that is around us. I think that if we take into consideration the morning session, all the keynote speeches and presentations, and even the first panel, we can say that we cannot have too much doubt about the fact that we are facing really challenging times and we are facing really unprecedented challenges, including that green challenge, that climate change challenge. Here at the Central Bank, we say quite often that these days or these decades, we are living in an age where we have a lot of mega trends who are shifting our worlds, including technical change, digitalization, or money revolution, as we say it at the central bank, and also a kind of revolution of thinking, a revolution of thought concerning, for example, green issues. If we remember that, I don't know, 10 or 15 years ago, the green issue was not as topical as it is today. So, and even the scientific support, the scientific background was not as trivial as today. Now, you know, with a small exception of the public opinion, quite everybody agrees on the fact that this is an issue and we have to do something about the green challenge. And that's why I think that it is also important for the financial sector, because financial sector has to take into consideration the demand of coming from the public side and coming from the client side. And this is what we are seeing right now. So that's a great challenge. We have concerning the monetary side. We have estimates. We have estimates of the World Bank saying that something like $90 trillion have to be spent in 15 years. That was for between 2015 and 2030, the period of 15 years. A quite similar estimate was given by the OECD, saying that approximately $6,900 billion have to be spent every year. We have also heard during the morning session in the presentation of one of the presentations that there is an estimate given by McKinsey saying that it's a little bit higher. So they say that more than $9 trillion have to be spent per annum, so every year. Which we see that, and also we have Mark Carney saying that we have $100 trillion challenge for the next 15 years. So the numbers are huge. And the need for investment is quite huge, and that's why it's quite logical to see the financial sector involved in that question, because someone has to finance these investments and all that need of investments. The title of our panel is The Transformational Power of Green Finance, and when I saw for the first time that the title, my thinking was that, oh, it's a quite ambitious title, because it means that finance has to do something with that issue, and not only in a sense that we have to support something, but we have to transform something. I don't know what exactly. And my first question would be about the title of our panel, and I would like to ask you to give us some thoughts and ideas concerning the title, saying if you believe that the finance or the world of finances can have such a transformational power concerning green issues or not. And if you, when you respond, your personal comments are also welcomed, but also the position of or approach of the company that you represent is also welcomed. Thank you.
Thank you very much, Paul, and thanks for having me here today. Transitional power of green finance is well accepted by us as Unica Group, and I'm very much convinced that this is an obligation. We started out within our group in 2016 to take a closer look on all the megatrends worldwide and what is influencing Europe and how Europe will deal with all the consequences, migration in those days, and also then the shrinking society, the overaging society, the phenomenon everyone lives urban, and then the environmental consequences, which are absolutely endangering also for Europe, that we can't be silent anymore, and that we need additional to our financial strategy also an integrated strategy which features the non-financial part. And by looking into the details, we ended up that we have to be much more transparent for what we stand for, and we built our strategy first before we go then into the approach, that we align our investment strategy to well-established and detailed, committed memberships and alliances. This sounds simple, but if you sit on the table with your board and you ask how to go down this road and how to convince all your stakeholders, customers, but also your human capital is of relevance, and your investors and the public, if you need them as partners, you end up that you shouldn't invent the wheel new. And if you look into the commitments, and we signed up also for a principle for sustainable insurance and also for principle investment responsible investments, that finally going net zero is now following how to deal with the hard currency CO2. And we are currently now working on the interim targets, how we reduce our CO2 from our portfolio, our Scope 3 emissions until 2025 and 2030, and file it with SBTi, that this is well aligned. But the funny thing is then, what would really then, within the engagement of all your peers and members in the alliances, what really brings it to a successful end? And this brings me back what we discussed also during the breaks, that talking alone will not fix it. I think you have to build on regulation, and you have to build on business rationale. And this holds true also for our own group when we considered is it worth to engage, and how do we get this back, that there's a certain delay, that the engagement in the non-financial dimension doesn't pay back probably in short term or medium term, but there's a definitely positive correlation on the long term, that it also pays back through the financial performance. And when you then consider how should my portfolio become net zero, you have then a quite direct obligation to speak out that tight regulation for real economy might be useful, because if the best engagement doesn't move real economy, regulation should fix it, if this is the mandate from European citizen. And for this reason, we are much more proactive to all the regulation coming up, because it supports that our portfolio is moving and real economy is also moving. And this then goes on the liability side, where we have our underwriting, so different from banks. There are other risks working on our property casualty business, and there it's even much more tricky, because talking to investees is not so risky from an investor side when we are the investor, but talking to a large corporate which picks up our insurance cover and tell him what he should probably consider more, and what moves are necessary that he walks the line 1.5 down to net zero, has a certain risk that he won't turn around. But if you then consider what we're heading for in the taxonomy KPIs, in the future corporate sustainability reporting directive, they are asking if you got a purpose. Wow, okay, so have you got a strategy? Wow, again. And how did you derive your targets? Super, tell me about your judgments on risk and opportunities, and now the measures and how you run the business. You end up that you need a business rationale. So we are currently in a quite good stage that we, what is probably today more interesting, build up a green portfolio from 400 million to 1.7 trillion in 3 years. But we're engaging on the CO2 intensive investments. What is important, but after a couple of years, the exit is probably now more difficult, because instead of hidden reserves and a positive gap from acquisition costs to the current market price, we have now, due to the interest shift, a quite uncomfortable exit consequence that you usually are in danger to make a loss. But the overall approach in relying on the alliances, and a special alliance founded in Austria, helps us. We have the global net zero asset owner alliance, which has 11 trillion assets under management combined, and this is powerful. But the common denominator is not that easy to find. If you are asked by the Austrian ministry, for environment and climate change mitigation, if you are committed to step out of coal, oil and gas, coal and oil by 2030 and gas by 35, and liaise and cooperate for Austrian targets. So by this approach, we are committed to also address our investees and our customers who pick up insurance coverage. And if you read the papers, for example, there is a recent paper, a draft actually from PICAF. It shifts to the insurance industry not only to deal with the large industries and with the large corporate clients, it also recommends that we take responsibility for retail customers. And there is a whole section how to calculate and how to disclose and how to work on reduction for your MTPL CO2 consequence in your motor portfolio, so casco and third-party liability. So we are in the middle of this journey and truly committed and speak out very positive also in accompanying regulation, especially also on the regulation which is upcoming and already mentioned in the panel before. The tight disclosure regulations starting for the business year 2025 will be hardened from end of 25, 26 by complying with the Corporate Sustainability Due Diligence Directive. And there is an Article 15 which says walk down the line, the 1.5 Paris-aligned pathway, and walk the transition with us. And as mentioned, if you do not set up your governance as a director, which is a supervisory board member and a board member, the member states shall take care that civil law allows for action, open up whistleblowing, and if this doesn't work, think about fines based on the total premium volume. So in this context, we are highly committed, and of course we can then talk about technical aspects in certain forms, what helps most. I think the discussion is out there for 10 years. If it's a killer, if you go for green investments, that you lose performance or yield, or if it's even smarter, and I'm looking forward for a discussion on that.
Thank you, Paul. It's almost 4 o'clock, so allow me to be a bit romantic in my vision of the green finance. I think that the role, the essence of finance is to transform challenges in opportunities. That's the role that we have. Allow me to, well, in Europe we start to speak about finance when, well, we can say a family, the Medici, they invented actually the banks, and they move out to Europe from the most terrible pandemic wave, the black pig that arrived in Europe. And they built what is an idea movement, which was called the Renaissance, that lasted for probably centuries. You still have now your currency, if you're in it. It still the name that was invented by the Medici, because it was the new gold benchmark for the economy. This transformed completely Europe. You could not have Rome, Venice, Bruges without that kind of revolution. So I sincerely believe that great ideas can change the world and can make impossible mission possible. And this is the essence of finance. At the macro level and also at micro level, every single person sees finance as a social lift. I had no money to buy my house. I have to say, very grateful to my Flemish banks that in Brussels is giving me the money to ensure to my family a nice house in Brussels. So we have to enter and we have to change the mentality of 500 million of European citizens and maybe almost 8 billion of global citizens. Because we should not forget that this is a global challenge. And in Europe, we have only 7% of the global population. So we have to work together with our partners all over the world. We have to manage the complexity. The bad news is complex, but as everything. Allow me to make another reference. For centuries, for thousands of years, the economic system was based on the slavery, which was the normal way how to secure economic growth. values, good ideas can change this. In a few years, we were able to move completely out from slavery, at least in the civilized country, and change completely, radically our economic and financial background. So we have to have hope. The situation is dramatic. Inflation is going up. Interest rate is going up. But the financial world is designed to manage difficulties and to give stability to the system. And I really believe, and I represent 2,000 banks, that we can make it. At the European Mortgage Federation, we have designed a new benchmark, like the Fiorino of the Medici, to build a green mortgage, where every single European citizen can tag their EPC, their energy parameters in the asset, can give this to the bank, and automatically the bank can use this information internally. There are 5 reasons why I think it's very convenient for all of us to build this ecosystem. Because it should be a win-win process. For you as a citizens, I think that probably you have to renovate your house. You don't know it. You are here, you think, nice, this green thing, but you have to go back home and convince your wife or your husband that you have to spend at least 50,000 euros to move your house up. In every single country it's happening. As Sean Kidden said, in France, you have to move out your house from G and F by 2028. In the Flemish area, so very close to Brussels, a few hundred meters, if you buy a house, you have to move the house to at least level D, in 5 years' time. If you don't do it, you cannot sell or rent the house. So it's an immediate risk. Go home, start to speak, start to negotiate. If your wife is tough, like my wife, it's a tough job. I mean, because you have to really convince your wife that it's an economical bargain. That's the decision of power. And then you have to go to your bank and convince the bank that it's convenient. And I have my Hungarian banks here in the room, so I have to convince them that it's convenient to make green mortgages. And then I have to come to Andreas as an investor and say, hey, it's convenient to invest in green cover bonds because it's really the best thing you do. So we have to change mentality, all of us. And that is done with a very basic method, incentives. Incentives. And we have to be very careful not to use only fiscal incentives. We have to help our member states to build a monetary policy that can help in managing this from a banking sector. Because fiscal incentives, they increase inflation, and now we cannot afford. I will stop here. I'm Italian, I can speak for hours. I will.
Thank you very much. But if you want to convince my wife, you have to also take your time because it's not easy. If it's about renovating my house. So, Mr. Clisson, please.
Hi, good afternoon. Thank you very much for the invitation. So I'm working on the asset management division, so I bring maybe a complementary view from the other panelists. I guess as financial institutions, we have 2 main levers we can activate, and definitely these levers have making a difference on our economies. The first one is how we allocate capital, and we can make a proactive decision, as was presented before, on how we allocate capital to which activities. We can support more green activities. We can stop financing some of those. And I mean, even if it can be a little bit not necessarily easy to demonstrate the positive contribution of this decision into the driving the change, I think it's fair to say that by taking this kind of decision, we are giving a price signal, and also we are changing the cost of capital. And just to give you a concrete example, in our private debt strategies, we have we invest in infrastructure, and it's becoming harder and harder for us to be competitive and to offer good financing condition for a green project, because everybody is willing to finance this kind of project, and they can get very profitable, very interesting interest in other actors than with us. So I think this is a clear demonstration of how the fact that all the industry is trying to get more green assets, is trying to shift away from fossil fuel activities towards more green activities. This is bringing a difference in terms of cost of capital for the industry. So this is one of the pillars. And the other, we as asset manager, we have a power that maybe the rest of the industry does not have, that we can vote in annual general meeting. So we can use that to influence and through our stewardship activities with corporate, but also with regulators, with the rest of the industry, with our clients, we can make a clear difference again here by trying to convince the rest of the industry to join us in our efforts to drive the energy transition. At BNP Paribas Asset Management, we have been using these different levers really to try to make a difference, and we were convinced that finance can definitely bring the needed change to achieve the targets. We mentioned net zero. If you look at the numbers, the number of financial institutions that have joined the Net Zero initiative, I think it's quite impressive. Now we need to work together to define the proper metrics, to define the proper tools, to find the great methodology to ensure that we are aligned when we assess companies, when we assess projects, and to really bring the difference. Yeah, so that's pretty much my answer to your basic question on do we believe finance can make a difference and bring the transformation? Yes, for sure. And yeah, I encourage everybody to join all the investors initiatives that exist everywhere. We mentioned the Net Zero Asset Owner initiative. There is the Net Zero Asset Manager initiative. There is the Net Zero Banking initiative. We, the BNP, have joined the different initiatives, and we're trying to work together to make a difference.
Thank you very much. I think that we can all agree with Mr. Ederson, who said during the session, the morning session, that it is quite factually impossible to make the green transition without finance, so the inclusion of or integration of the financial market. I absolutely agree with that. Concerning the title of the panel, let me say some thoughts and words about our approach as a central bank, because I think that by definition we really believe in the transformational power of central banks, at least, but all the financial system. All that we do in that field and in general as a central bank is about what you said, about giving good incentives to the economy and the economic actors to behave in a way which is beneficial for the whole community. I think that's the definition of policy making in general, but this is what we are doing also. Since it was also mentioned by the Deputy Governor this morning that since 2019 we have a lot of programs concerning green activities. So we started with a green program, which the objective which was to transform a little bit the financial sector into a greener one, and I think that we did a lot to achieve that goal, to meet that target, and including macroprudential programs and instruments, and also what was quite interesting and big achievement from our side, that was the publication and the adoption of a strategy about the monetary policy operations, which is not really typical among central banks. That, you know, concerning financial stability programs, it is quite common to have green elements. I would say that in Hungary we have a lot of green elements in that macroprudential field, but all in all, in other central banks we can find other examples. But concerning monetary policy, it's a little bit more complicated, because monetary policy is quite focused as an activity on inflation, etc. And when we accepted and when we published our strategy last summer, it was a quite, how to say, new approach in the community of central banks. What the main message was that we try to integrate green elements into our monetary policy operations. Of course, we have to take into consideration the fact that we have a primary mandate concerning inflation, so that's always the primary goal of the central bank. So we cannot have any green element which is contrary to the price stability mandate. But our experience was that it is possible to integrate green elements into monetary policy programs without hurting the initial objective of these programs, and this is what we did. You mentioned the green mortgages. We have also a green mortgage bond purchase program, and we used all these international standards, and I think that with the cooperation of Hungarian banks and mortgage banks, essentially now we can say that we have a market, which is for green mortgage bonds, which was not the case 2 years ago. So I think that, for example, that can be seen as a good example concerning the transformational power of finance, because if we give good incentives to the market players, or even to households or any other agents in the economy, it is possible to have great results, and I think that was the case in the case of our program also. Concerning the green finance, I think that most often we refer to the green bonds and give mortgage bonds. Normally bond markets are under pressure, like other markets right now, because of these unprecedented challenges that we are facing. That it was also mentioned several times during this conference also. So I do not want to repeat them. Everybody knows that we have that kind of shock on these markets. But despite these difficulties, I would say that the green bond market is quite there, so it is growing, and we have issuances. We have representatives from Austria. That was quite a strong period for Austria concerning green bonds, especially this May-June period when you issued, there was an issuance of a green government bond, if I know well. So. I just would like to ask you about your stake concerning the actual state of green bond market or green mortgage bond market. What are your expectations concerning the future issuances on the side of the issuer, on the side of the investor? So it depends on your position, of course. Please.
My side. Yeah. Well, since we started to discuss about green mortgages and green covered bonds, our banks have issued in Europe, we have more than 50 billion of assets on our covered bond label website, which is a very transparent platform where all the investors can see all the assets put in the cover pool, the characteristic. So I think transparency is something that can really help the financial markets in play their role. Also can help I will say, also the inflation, allow me to say, because transparency can really help on the financial markets or capital markets, investors to have access to good portfolios, and also can help the consumer to get a good view on what kind of product they can have, or what are the conditions. So transparency is the key word to manage this green revolution, I will say. In terms of expectation, why a bank should produce a green cover bonds or a green securitization? Well, first thing, allow me to say how difficult it is to do a green cover bonds. First of all, you have to line up the strategy of the bank. And allow me to say that, I mean, this conference and the policy of this central bank has been really important in giving clear instruction to board level people of what was the thing to do. Because the role of the central bank is being the lighthouse in the middle of the storm. And actually, this central bank was so brave, and allow me to say, because I speak with central banks from Singapore till South America, to be the first central bank to understand exactly what were the implications of this green revolution and to implement a clear sign for the financial operators that that was the direction to take. Why is it important to convince a board-level decision? Because the bank have to invest. They invest in IT system. Mainly, the green revolution is an IT problem. It's an IT problem for the banks, but it's also an IT problem for the states. Allow me to make an example. I will not say anything about Hungary because it's politically incorrect, but I will say about my two countries where I have two passports, Belgium and Italy. So a bank in Italy, for example, if they want to have access to the EPC, Energy Performance Certification, the very famous ABC, they have to go back to 20 different regions, because every region have different database, and then they have to ask, do you have the APC of this list of people that probably live in your region? The response of these people in Italy is, well, we don't have the database. We have a database that cannot speak with your IT system, or we cannot share this with you for GDPR reason. Okay. So the only solution that we have is greenwashing. Because, I mean, what do you do? I mean, on one hand, you have EBA, the European Central Bank, and the European Commission telling you that you have to do green bonds. On the other side, you have no access to information. So this is a serious challenge. So a board has to decide between either inventing the EPC, either making proxy, and this is real bottlenecks that, I mean, are exogenous from the banks. The banks cannot fix it. We need the regions or the European Union, I don't know who is in this, online, or that they need to fix this problem, because otherwise the value chain is not able to. And then in Brussels, there is a very dangerous game now. Everyone, when we speak about sustainability, they move the problem to someone else. No, the banks have to give the green mortgages, or the investors have to do the due diligence, or that there is always. So we have to be very careful. We are all aware of the challenge, but everyone should do their homework. So member states should build national database, make information available, fix the GDPR problem, and give access to this information. Otherwise, the green bonds cannot happen. Why green bond is important, and I conclude, because an investor can, first of all, participate to the transition, which is the topic of today. Secondly, diversify the investor base. Make more stable their investor base, having access to international capital markets resources, and on top of this, preparing the bank to the compliance challenge. So preparing the bank to disclose the data as the European Banking Authority wants, as the ECB wants. So it's an exercise, it's an education which is fundamental. I stop here.
Yes, Andreas.
Yeah, thanks, Luca. I just want to add a different aspect to what you mentioned. Can you combine green bonds, green covered bonds also with a certain regulatory positive supporting factor? And our industry has committed that our regime, it's a Solvency II regime, has to be risk-based, and we did not raise the hand for any kind of green supporting factor so far. But the interesting question is for me, if you have the judgment that whatever, or also the example Luca mentioned, that what is so pushing that you will not be able to sell in certain countries premises if they are not in the right shape, that you have to read the future regulation, how much backwind this regulation will bring, and how the current normal or brown industry will have front wind. And so far we have not seen any kind of considerations that whatever we plan, and the regulation upcoming is quite tight, that we project this into the regulatory systems. And so far we're only talking about tech support. But the interesting question is, isn't it really worth to consider all the circumstances and also take in future regulation as a potential green supporting factor? And just for the end, the standard model what we have in our industry is also not completely risk-free. If do you remember that we started out by governance bonds, keeping them out of any kind of regulatory burden. It's also a long way to get this then to the internet model and to have it completely then risk-based. So our experience, aside from green bonds, is that the covered bonds in our portfolio are not so easy to sell, and we're currently looking into options how we can learn and find opportunities for next investments. But what we did as an interesting hint, we did a hybrid green bond. We did 2 green bonds, and the hybrid green bonds is linking the use of proceeds to the volume you picked up, but as a hybrid bond leverages your business, you are entitled to go for new business. So far, all the frameworks do not consider any kind of guidance what you should do when you could scale up your business. So you just raise what we did in one case, 200, 300 million, and you have to go for 200, 300 million green investments. but the room you get to make new business would currently not be restricted that you go for underwriting brown industry. So this is something where probably also the system, by accompanying the green bond framework also in the hybrid stage, could need some deeper guidance.
Thank you, Mr. Clisson. You have anything to add?
Yeah, maybe just to add a little bit on what Lucas said. I think it's not just a matter of IT; it's also a matter of standardization. Just if we keep talking about the APC, for us investors, it's very hard to compare an EPC from one country to the other. So maybe the new EPBD will help to have some sort of standardization. But as long as we don't have the tools, the metrics, the right data to assess the underlying mortgage loans, it will be very hard for us to investors to really, make a distinction between a normal covered bond and the green version. We're very supportive of a green covered bond. I mean, it makes a lot of sense, but at this stage, we really need more data to be able to make a distinction between themselves. There is no such greenium in green covered bond at this stage for this specific reason.
Thank you very much. There is a quite interesting segment of green bonds, which is the sustainability linked bonds, SLBs. And some people say that that can be the future because it is really focused, and this is something which can be very effective in achieving our goals concerning that green transition. But at the same time, this is a segment which is full of uncertainties. At least this is my personal opinion. So, what do you think about that segment? About the ambition of that segment, the credibility of that segment, and maybe a sub question of that question is also linked to the question of the data availability. So, it is possible to have access to data which makes that segment of the financial market an effective and efficient one.
I will start.
So,
Thibault,
go ahead.
Thibault,
No, go ahead, please.
No, please.
We as investors, at least at BNP Paribas Asset Management, I mean, from a philosophical point of view, we like sustainability linked bond. It makes a lot of sense. You're making a link between the achievement of environmental and social targets with the coupon. So it makes sense from a philosophical point of view, but the implementation of the sustainability linked bond at this stage has been a little bit disappointing. I guess there are a lot of different reasons why it's not so appealing from investors. First, how companies have decided the KPIs that will be used to track the achievement of these environmental and social goals. Second, which is also a link to the same issues, the fact that you don't have impact reporting on SLBs as you have, for example, on green bonds. Well, sometimes you have some time lag issues. The achievement of the specific environmental or social targets will be made in maybe 10 years from now. So companies will take a commitment to reduce their greenhouse gas emissions by X% by 2030. And during the full period of the loan, you will have no information, and maybe 1 or 2 years before the target, you will realize that the company will not reach the target, and the impact on the company will be very limited. So there is no real incentive in achieving those targets. Failure is not really penalized. So this is some of the reason why, from an investor point of view, we are not very keen to buy SLBs at this stage, and we prefer the traditional use of proceed way of financing companies, if you like.
Well, as I said at the beginning, I think that in this sustainability discussion, there is a major risk that we leave someone behind, in the sense that the social inclusion aspect is a critical one in all this debate. How many of you are living in a house which is A? Okay, so that's already the answer. I mean, I hope that you're not so shy, but I mean, for all the rest, the challenge is very important. And you, I suppose, you have all the means and all the tools to face this challenge, but there are millions of Europeans that, I mean, don't have the way to manage this. So if we don't take in consideration the energy debate, the energy discussion, energy efficiency, by considering that we need instruments that can help in managing this transition properly, I think is a risk. Because people outside of this room are not understanding this debate. You are asking them to renovate the house, change the car, buy a bike, change the school of their kids, and all together for the first time. And people cannot afford it, simply. I mean, in the meantime, energy price is going up. The price of the bread is going up. The price of everything is going up. So, I mean, we have to be very conscious that we are in a critical moment. And sustainability should be seen as an opportunity. We need instruments that can allow banks to play a cathartic role in the old Greek word. Cathartic, it means that you transform something brown, little by little, you move this to a green level. And this cannot be done overnight. This can be done with a lot of instruments, and I think that we need a lot of financial instruments that will help investors to understand what they are buying, and accept also a gradual approach. Only 10% of the European dwellings have an EPC, residential side, and only 3% of the public building have an EPC. So for the rest is close your eyes and good luck for the investors. So I mean, that's the reality. Then we can pretend that everything is perfect, but it's not perfect. So we have to be practical, we have to be very careful that if we don't explain this green revolution to the people outside of this room, we can lose the battle. The French Revolution started with a baguette because there was no bread. And I think that we see this in all the elections around Europe. I have an Italian passport.
Yeah, just short adding the idea of having a step up in the interest when you do not meet your ESG performance is quite nice, but we did not invest so much because we see that the measures and the metrics are not that much developed. I was on a panel end of the summer. It was called Investing into Peace, and the question was, what can you do that someone who, or especially governments who work out in a negative way and endangering peace, if this could be supported by any capital market instruments. And this is a very difficult one because this would not even refer to a step up. You would also need kind of default clauses when you treat human rights too badly. The question is, if we once get there, that capital markets learn from experience and that governments also think about much more consequent measures, and this is something what they see far away. So for that reason, we need much more guidance and more precise metrics around sustainability-linked bonds.
Thank you. You mentioned, Luca, 10 minutes ago, something, 20 minutes ago maybe, the example of Medici's and the Renaissance and Italy, which is normally I personally really like historical examples, but especially when it has a positive message, and that was a positive message, I think. But it is also true that there is a quite big question mark on my side, saying that, okay, everybody is trying to do everything. The financial sector is dedicated to meet the demands, and this is the function of the financial sector, etc. But normally, what we hear every day, that we have no time for waiting too much. That maybe we have to go step by step. We have convinced everybody, including my wife, which is a little bit more complicated. But all in all, how do you see that conflict between the speed that we see concerning the green transition, including the financial sector, and the time that we have, according to the scientists, saying that, okay, this is the last moment. We have some people who say that, okay, until now we were thinking about adaptation and mitigation, but now let's start to focus on adaptation, because mitigation is, for mitigation, maybe it is too late. And if we are talking about adaptation, let's think about the deep adaptation. So change your mind and change your way of life, not to mitigate all these problems, but to get adapted to the new situation that you will face. So how do you see that conflict of time concerning the green transition? And maybe we can include another question to this one. We can ask how do you see the role and the responsibility of the state, of the community in that conflict? Please.
I try to, well, for me, there is, I will answer using the word of René Descartes or Cartesio. I think the method is the only way to face this challenge. And the method for me, it means governance. And in governments, and I would like to underline again the important sign coming from an institution like yours, your institution, to give clear instruction of what is the strategic path in front of us. I think for me is the role of the European Union, who decide to take the leadership to propose a governance, is trying, sometimes a bit with a bit of confusion. We don't know if we have to do right or left, but anyhow, the European Union has given a clear sign to all stakeholders, that's the direction. And that's I think, the only way to manage. At the time, unfortunately, the war, unfortunately, probably this winter will change the mentality of the consumer. I mean, everyone is going back to work in the office because staying at home, turning on the heating, it's, I mean, I don't know if it's the same in your offices, but in Brussels, people are starting to come back to the office because, I mean, the heating is changing the mentality of people. The winter is about to arrive. So I think that probably in 4 months' time, the concept of time will be different. But I think only with a clear governance and transform complexity in simplicity, which is, I think, a role of financial stakeholders, can be done. We have to have clear instruction, and I hope that one day we will have a commissioner for the transition that is maybe more important than other economical sector. I think that we need to have a clear governance, someone that give clear instructions to 420 million, how many we are in Europe without UK. I'm old-fashioned, I was including UK before in the 500 million.
Okay, thank you. I think we are in a hurry. We have to speed up. And even now we have a certain pressure and certain blaming if you have still this investment in your books when you have to disclose now in 2024 starts with the CSRD how much you have improved. But the tricky issue is that according to the law of physics, that energy doesn't go away from the planet. The question is, where does the brown investment go to if we haven't got it in our insurance books and it's not there, it's not there. And you find it then, there was a good article in The Economist, you find it then 3 or 4 stages, repackaged, down there, fund of fund, fund of fund. And this is sold to not so experienced institutionals, small universities, in the pension fund. So I think it's mandatory that you really catch the brown industries and not just take care that large banks and insurance companies are out of these investments. And for that reason, I think it's underestimated how relevant engagement and tight regulation and broader disclosure is needed to really then force the real economy from brown to green.
Yeah, on my side, I think it's fair to say that despite the fact that Paris Agreement was signed almost 7 years, we haven't made collectively a major movement or major action to really reduce greenhouse gas emissions. The situation is not where it should be. There is some real urgency to act. But And the other thing which is also quite disappointing is we are still discussing ambition and not really implementation collectively. Just a concrete example, when I see the last announcement by India on their national determined contribution, where they say part of it will be conditional, it's a little bit disappointed. And the last point, I think it's very important to understand that in Europe we might be doing the right thing, we are going to the right direction, but we can't succeed alone. And if only Europe try to reach net zero, put in place the regulation, put in place the money, put in place everything which is needed, the change in behavior we were discussing, but the rest of the world is not doing it, it will be a collective failure. So that's why I think it's not only the responsibility of the state, it's a collective responsibility. Any stakeholders need to take its own responsibility. We, as the asset management industry, the financial industry in general, the citizen, the industry, everybody needs to take its own responsibility and to act into this direction. Otherwise, it will be a failure.
Can I add something, Thibault, something you said? We had actually 2 days ago in Venice a conference with all our members from Tanzania, from Africa, and one of the Tanzanian member told us, in my country, most of the houses have still to be built. Please give me standards that I can implement. And allow me to say, like the complexity of taxonomy. I mean, I'm sure that the best engineer in this room will not understand what taxonomy compliant mean. How we can explain to people that have to build billions of dwellings in India? Where is the problem? I mean, we can make our house the most energy efficiency. We will not fix the house if Nigeria, if India will not follow a green way. So this is a call as a user of taxonomy. Please make it understandable to me and to the other millions of people that would like to use it around the world. But I mean, it's simply, I mean, perfection, if it's not implementable, it cannot be used. I mean, so my call is, I can afford, I work for a small institution, so I can be provocative, is please help me to understand taxonomy, because I would like to make it understandable to Andreas that has to buy billion of covered bonds, and I cannot make a spreadsheet that will help Andreas in understanding what I don't understand. And if I don't understand, it's a bad sign. I'm quite basic, so I mean, I need to... so that's a call. I think we have an opportunity. Let's don't forget, let's don't close our eyes only to Europe. I mean, the problem is outside Europe, and the opportunity, let me say, is outside Europe. There are billions of houses that have to be built in Brazil, in India, in Tanzania. If we are unclear, we lose this opportunity. Sorry.
No, thank you very much. That was very interesting. And sorry, even if the challenge is huge and the difficulties are really, really big, we have to respect the time limits that we have. So we are approaching the end of our panel. And let me be also a little bit more provocative with the last question. And I just would like to ask you to give a short answer. The question is the following: are you optimistic or pessimistic about the future from that point of view? Or are we going to fail? Are we going to succeed? And how do you see your industry in, what is your vision concerning your industry in 10 years' time? How will your industry be in 10 years? Andreas, please.
I think we, and I personally anyway, are very positive that we have to get through this challenge, and there is no alternative. So when you hear that Chinese are doing that, if you're doing not that, everyone is suffering under these circumstances where climate change is now proven. We are very late, and we have to get moving. And Europe is truly right to push that. And I'm convinced that the other continents will more or less follow. And I think it's right what has happened so far in terms of regulation. But Luca is right. There's a problem with the taxonomy. I can also confirm that applying the taxonomy, which is only half the way down because there's a lot of parts missing, is something where we still have to get together on the table because I know people who were sitting on the sustainable finance platform, and they have not been explicitly talking to the industry. So I think what would be helpful to be constructive for the future, and in this direction, look, let's get it done, let's get it fixed, and let's engage with the sustainable finance platform to improve the taxonomy, also the missing parts.
Thibault? Or...
Yeah, I think we all need to be optimistic, otherwise all our discussion will be useless. I mean, there are a lot of positive signs. The fact that 90% of the global GDP is now under some sort of a net zero commitment. 3,500 companies have joined the SBTI. All these kind of signals are very positive. I think it's the journey on just the level of knowledge, the level of just sensitivity around those topics are grown a lot over the last couple of years. So I've been in the industry since 2009, and just the level of discussion we have now with the different stakeholders is completely different. So I think now nobody is really doubting about the climate change reality, and it's more about how we will reach the targets, the next topics. I think is quite optimistic. And regarding our industry in 10 years, well, I hope we will succeed in delivering in our respective commitments, for sure.
Well, I remain very optimistic, also being aware that the situation is very, very difficult. We have to be careful to defend also the competitiveness of Europe in this respect. I'm speaking about the banking sector. We have to make sure that our banks will be competitive. We are implementing Basel III, we are implementing sustainability, and the banks are the engine of our economy. If we limit their capacity to support this transition, it can be dramatic. Where I hope to be in 10 years' time, I hope that all my 2,000 banks will be issuing only green mortgages and not anymore brown mortgages. That's my hope. That our ecosystem, where a consumer can go check their project of renovating their house, will be available very soon. I hope that we will have an Hungarian hub here very soon, and that all of you can find easily a plumber and a loan that can allow you to retrofit your house, because you have to do it. So go back and speak with your wife tonight.
Thank you very much. And finally, I will also answer my own question. So I'm also optimistic because there is no alternative. And I think that it is also feasible if we will see a much more active state on this process. And I also think that even central banks will be much more active in that side, because otherwise the tragedy of Horizon will be the tragedy of humanity. This is my personal opinion. But we have a long way to go. We have a lot of things to do concerning the taxonomy, the wives and the husbands, and the renovation of houses. So thank you very much for the very interesting conversation, and for the audience also. Thank you very much.
Thank you very much.
Thank you, Mr. Kolosi, and to all the panel participants. Ladies and gentlemen, as the event is coming to an end, and I would like to invite Mr. David Papp of the Sustainable Finance Policy Division of the MNB to give his closing remarks on the conference.
Well, thank you very much. Just a few people left before I entered on stage, so it's a good encouraging moment for me to speak a little bit as the last speaker in this conference, and I'm in a very difficult position because I'm standing in between you and your very well-deserved evening break. So I hope I can be really brief. I'm not Italian, so I cannot talk a lot. But maybe, Luca, you should give this talk because I really like the way you speak. Well, I set myself the really impossible task to first follow everything very alertly and try to write down what we have consensus about. And it's really, I'm a bit sorry to say that the only consensus we have is that the taxonomy needs improvement. And that's really not good news, I think, for the sector. But jokes aside, I think we have certain things that we agreed today. We had very interesting talks and interventions in the morning, so I think we heard today that basically, yeah, we're living in the era of big changes. The example of Pakistan came up today a lot about the floods in Pakistan, so I hope that's ingrained now in your memory that there was a flood in Pakistan, but it's true. So we are living very difficult times, and it's actually what a very grim scenario of climate change will look like. Lots of physical risk being realized, and also high energy prices, transition risks. So I really liked when Frank Elderson said that yeah, basically today there is a consensus about that climate risk is actually a financial risk. So it is within the mandate of central banks to address this. So, and I also wrote down that mostly the speakers in the first section said that governments are in the driving seat. It's government policy, so it's government policy that is driving climate policy, right? So there's so much that the financial sector can do. But actually, in the afternoon, we said that there's a lot of things that the financial sector can do, and a lot of things that financial institutions, asset managers, commercial banks, multilateral development banks like the EBRD can do. And we have heard a lot of really, really good examples and really inspiring examples from the colleagues who have been speaking here, talking about transition plans, talking about their approach to decarbonize their portfolio to help the green transition. So I think there has been a lot of inspiring thought, a lot of material that we can take inspiration from and we can work through. I also heard, I wrote down that, well, the green transition is a big business opportunity. We heard some really large numbers about what kind of investment volumes we need to realize in the coming years. And I also heard a really good thought, I think, thought about how the economics is changing around the green transition. So unit economics, like how green technologies, if they can get to scale, can really transform the markets. Example was, for example, the hydrogen, or the past examples are like the cost of solar panels. So that's why I think most of the speakers today, I think, were optimistic, as we heard also in this last panel, that eventually the green transition will accelerate in the future, and we cannot really afford that we do not accelerate the green transition further and greening the financial systems further. There is still a lot to do. I also wrote it down. There is still a big discrepancy between what we see in the real economy. In capital markets, it's still very carbon intensive, heavily tilted towards carbon intensive assets. And at the same time, we see the emergence of green finance, really large growth volumes in green markets, but this is not enough, so we really need to step up. And as I said, governments and financial institutions and the whole ecosystem around this is really important. I also wrote down that maybe some models are wrong today. I think, Mark, you have said that we need to look at climate risk maybe in a bit different lens. We need to look at in more, how to say, we need to look at other scenarios that are really helping us to translate what physical science are showing us today. If we don't transform our economy, what the consequences will be. We need to translate the physical science, so natural sciences, into our financial models better. I already mentioned the really good examples that we heard from the different contributors today. So I really encourage the audience, my colleagues as well, to let's have a look at this and let's get some inspiration from all this. From all these ideas and take some inspiration from them. So I don't want to keep you much further from your evening break. So as final words, I would like to really thank all of you that are here, especially those who stayed until the end. It's really a great, shows a great commitment. We're really grateful for your presence. It really helps us as the Central Bank of Hungary to advance our work further, and I think it also helps the local Hungarian ecosystem to also develop further in the sustainability dimension. Very much thank our speakers, our guests who traveled here to Budapest today to give their great views and interventions. You really contributed greatly to the discussion, and we're really thankful for that. So once again, yeah, I hope you haven't. So if we invite you next time, you will gladly accept it again. I hope you have enjoyed today's conference as well. And lastly, I would like to also ask my colleagues who were helping a lot with organizing this conference and technical support, and everyone who really worked hard to make this conference happen. I think without their great work, we couldn't discuss these issues today. So maybe as a last thought, I try to. It's always nice to think about a narrative of how we would maybe sum up a conference like this. We could say that the last 4 years, that's the 4 years since the National Bank of Hungary has started looking at climate and environmental issues, was the first era of sustainable finance or green finance. And we see that we arrived at the crossroads, and we are looking forward to the second era. And we really hope that in 4 years' time, when we look back, we can say that, well, the first era was the Great Awakening, maybe. We look back and we say the second era, the next 4 years, will be the great acceleration, as it has started already, but it still needs to continue. So we will work towards that end, and I really hope that your institutions will also do the same. So once again, thank you very much all for being here. And yeah, looking forward to seeing you again and continuing the discussion, the dialogue later. Please give us feedback about the conference, and yeah, come next time again when we organize this, probably next year. Thank you very much.